So 13:02 in my clock here. A warm welcome to all of you, dear contributors, dear participants. My name is Wolfgang König. I am the Executive Director of the Goethe University's House of Finance. On behalf of Goethe University in Frankfurt, on behalf of the House of Finance, the Leibniz Institute SAFE, and the Institute for Banking and Financial History, I warm-heartedly welcome you all to today's conference on international banking networks, sources of stability or instability, ? Evidence from the past and the present. I would especially like to welcome Professor Catherine Schenk, Oxford University, holder of this year's visiting professorship Financial History at Goethe University, Frankfurt. Professor Schenk, please let me say how much we are looking forward to having you here in Frankfurt, not only virtually, and to welcome you in the Goethe Universities and House of Finance's communities. I would like to thank you for putting together today's program with highly esteemed speakers, to whom I also want to extend my sincere and our sincere thanks for their contributions to the conference. Since the last financial crisis, an increasing number of academics and practitioners have been taken interest in the long-term historical perspective on the financial system and its current problems. This is also true, certainly true for today's audience. As much as we regret that we can only meet virtually today, we are delighted that this format allows us a truly worldwide audience to attend the conference. Thank you all for being here today. We owe a great deal of gratitude to our donors of the visiting Professorship Financial History at Goethe University, the Metzler Bank, and the Friedrich Förderungsstiftung, who also made today's conference possible. I would like to thank our donors for supporting us so enthusiastically and for being such a reliable partner to Goethe University and to the House of Finance. Before I now also welcome and hand over to Kim Comperl, member of the Partners Committee of the Bankhaus Metzler, for his welcome address from the donor side, let me thank Hannah Floto-Degener and her SAFE supporters and our SAFE supporters for perfectly having organized this event and will be organizing this event. And now please, Kim, may I hand over the floor to yours.
Yeah, thank you. Thanks also very warm welcome from my side. Obviously, we are very pleased to have this conference today on an online matter, so to speak, or an online conference, especially after last year's event actually got suspended to obviously the Corona crisis. Metzler, or Bankhaus Metzler, and our partner Friedrich Foundation, we are jointly supporting the guest professorship. And I just thought to give you maybe sort of 3 reasons why we are doing this. There are obviously many reasons, many more reasons, but I think that's sort of the 3 most important ones behind our own thinking. First of all, it probably is, if you look at Bankhaus Metzler or Metzler Bank, we've been founded in 1674. We are still owned by the same family, 12th generation. So history is actually something which obviously is in our genes. I think we understand and value financial history research. And if I look at our own strategy and if I look at our own thinking, we also use this and try to draw lessons, so to speak. What have we experienced? And actually take this forward to our own strategy going forward. So I think that's an important part from the thinking. The other bit is that the Metzler family always has been very close to Goethe University. Metzler family is actually one of the founding members of Goethe University back in 1914. So education of young people, education of students is something which is very close to our heart, and therefore supporting this visitor guest professorship is very, as I said, is very important to us. And the last point I would like to raise, I think it's also about exchange and communication. An exchange in the way of international exchange. So Catherine coming over, hopefully one day, hopefully next year. But Catherine coming over, having this international exchange. In a way, it's also an intercultural exchange, which I think is very important, and also communication is an important matter to us. And obviously, I mean, I think we all would agree that these are important factors. There were important factors, there are important factors, and there will be important going forward. And so, you know, there are many good reasons why we support this, but I think these three, looking at it from these three aspects, this is how we do it, and why we think it's a really good program. And we are also, if you look around, I mean, we're doing this now since 2014. The response has been extremely positive. And so we obviously are also very pleased with that. And, you know, let me maybe finish by saying, Professor Schenk, we are very much looking forward to see you and meet you in Frankfurt next year. Yeah, we were hoping last year, we were hoping this year, but I'm sure next year it's actually going to take place. And I wish all of you and all of us a very interesting conference today.
Thank you very much, Kim and Wolfgang. I am very regretful that we're not able to meet in person, but I also am really looking forward to coming to Frankfurt. It was a great honor to be chosen as the visiting professor for the scheme. And indeed, Frankfurt is the perfect place for my kind of work, where I hope to bring together academics, central bankers, historians, and economists into fruitful exchange and dialogue. And that really was the purpose behind the program that we built for this conference today. So as Wolfgang said, after the great financial crisis, there was a renewed interest in both the strengths and weaknesses of the international banking networks and that process of globalization, the identification of systemically important financial institutions, prompting different kinds of regulatory responses. So in a sense, we see these networks as being sources of resilience and liquidity, but also potentially sources of weakness or critical failure. One of the other aspects of the great financial crisis has been a huge upsurge in interest in history and in financial and banking history in particular. There was already a large body of work on the 19th century globalization, but also on the interwar eruption of a financial crisis. And I think the kind of links between current challenges and questions and historical research and new methodologies has really been extraordinarily fruitful. And it's a dialogue I hope that we can see here today. It now turns to me to introduce Linda Goldberg as our first keynote speaker, and it's an enormous personal as well as professional pleasure for me to do so. Linda is the senior vice president at the Federal Reserve Bank of New York, but she came out of the Bronx and headed to City University of New York for her education, and then directly on to Princeton, obviously a high flyer with a rapid trajectory, and then to the Reserve Bank of New York, where she's been since 1995. In 2012, she co-founded with Claudia Buch, who will be speaking later this afternoon, the International Banking Research Network. So her research interests and her leadership in academic as well as central banking really fits so perfectly with my own interests, but also the interests of this conference. I was so pleased that she's been able to attend. And she also spans that central banking to academic straddle that I'm trying to promote as a visiting professor at Princeton, at University of Pennsylvania, and at NYU. She tops the top 1% of economists, according to Citations, and she's particularly renowned for her work on international liquidity, international banking, and more laterally, the SWOTS network. And her research has been really profoundly influential. So without further ado, I'd like to invite Linda to address us.
Thank you for that very kind and warm introduction. So, I very much appreciate the opportunity to speak to this audience today. The conference around the Goethe University Visiting Professorship of Financial History, and in particular with it being held by Catherine Schenk. I actually first heard about this exciting program in a time and in a place that illustrates not just the importance of research on international banking networks, but also the importance of networks of international banking researchers. It was in December 2018 at a small Christmas dinner hosted by Claudia Buch in Wiesbaden. And seated beside me at dinner was Stephanie Calais, who's here right now, who I had not previously met. And we started to converse on international financial history. And she described this very initiative on which we meet today. Stephanie queried me about who I thought could be a great match for the Fellows Program. I replied, Catherine Schenk. And indeed, Catherine was already in their sights. And here we all are today at the very event coincidentally discussed more than 2 years ago. So networks of all kinds can be informative and impactful. So my remarks today will discuss themes in international spillovers and coordination through global banking, also through central banking. I will start with one form of cooperation specifically in times of elevated stress. That's the network of central bank swap lines, where my comments will focus on liquidity management across international banking networks. I will then pivot to a more medium-term and forward-looking perspective as research on international banking networks provides lessons that are important for the roles that global banks might play in economic recoveries across countries from the pandemic. My remarks are, I speak on my own behalf and not on behalf of the Federal Reserve Bank of New York or the Federal Reserve System. And my short remarks will draw on a series of papers by myself and co-authors. So I'll just leave those up for the moment. That's for the first part of the talk. So let's go to the topic of global banks, management of liquidity internationally, and central bank swap lines. So international banking networks generate cross-border capital flows. Large banks engage in cross-border lending to other banks and to both public and private sector borrowers. Some of these large banks are also global banks with branches and subsidiaries established in foreign countries. Some of the benefits and challenges of these types of organizations, as Catherine was alluding to, are discussed in a recent paper by myself and Claudia in the annual review of financial economics. I think that came out maybe August of last year. Now, in the United States, important roles are played by the hosted branches of foreign banking organizations, what I'll refer to as FBOs. And those roles are particularly in providing credit and financial services to commercial and industrial sector customers. They also provide extensive backstop financing for their clients via off-balance sheet credit commitments. So think of lines of credit. US FBO branches, so the hosted branches of foreign banking organizations, fund their activities in part through insured retail deposits that they get from corporations and uninsured, rather, retail deposits from corporations and money market funds. As these hosted branches are legally part of the parent banking organization, the liquidity and capital of the foreign parent banks are the primary shock absorbers for the branches in the US. The parent banking organizations, though, often manage liquidity globally allocating funding internally across locations according to the needs and business strategies of their organizations. So it's informative to think of these funding and liquidity networks in the global financial crisis and in the recent pandemic period with a history theme, but a very narrow one that's just since the 2000s. And also to see the roles ultimately played by dollars that became available through central bank reciprocal currency arrangements or swap lines. So let's start with the global financial crisis. In the global financial crisis, some European banks experienced difficulties in meeting their dollar funding needs. Many of those banks with US branches initially turned to these branches to source more dollars. This form of cross-border lending within banking organizations falls under the heading of internal capital markets. Once the central bank swap lines were activated and dollar funding availability broadened through the central banks, the private banks instead met their dollar liquidity needs through their own central banks. Indeed, in the global financial crisis, the outstanding balances at the central bank swap facilities peaked at over $580 billion and are widely credited with reducing dollar funding market strains. Rolling forward to this pandemic period, in March 2020, as the pandemic accelerated, the importance of cross-border liquidity through internal capital markets of global banks was again demonstrated. So let's focus specifically on the part in the United States around the US branches of foreign banking organizations. Before the crisis, before the pandemic hit in early 2020, these FBO branches had outstanding commitments like lines of credit, which totaled nearly $1 trillion, or about 40% of the branch balance sheets on average. This is the part in the United States, so about $1 trillion. The onset of the COVID-19 shock in March 2020 brought large changes to their balance sheets. Many of these branches saw sizable usage of committed credit lines by US-based customers, resulting in increased branch funding needs. So this is when the corporate credit funding markets were disrupted. Now, foreign parent banks, consistent with the structure defined by regulatory arrangements for where liquidity is housed, met these needs by sending dollars across borders to their US branches. This added demand to offshore dollar funding markets, alongside new demands for precautionary liquidity, some called this a dash for cash, and other strains associated with the role of non-banks, which may be addressed in Inyaki's paper a little later today. So what of the official liquidity response and consequences? Two pieces for the Liberty Street Economics series of the Federal Reserve Bank of New York on the slide provide some details. So the network of central bank swap lines with the Federal Reserve provided dollar liquidity. Here, some of the key announcements that took place in March 2020 are presented on this slide. These included addressing the cost of the swaps, the tenors of funds that were made available through swaps, the frequency of operations, and the span of the swap lines, as there are standing swap central banks, Bank of Canada, Bank of England, Bank of Japan, ECB, Swiss National Banks, and then temporary swap lines that also were activated. So in addition, a new what's known as Fema Repo facility was introduced and made broadly available to official account owners with the Federal Reserve. So this Foreign International Monetary Authority, FEMA, facility enables official account holders with the Federal Reserve to borrow against their foreign currency reserves, and those are typically held in US Treasuries. So these arrangements mitigate market stresses through a number of channels. They allow foreign commercial banks to access US dollar liquidity through their central banks, obviating the need to bid up rates in the private market. They help maintain the provision of credit, including the funding of credit drawdowns by firms. And they help avoid fire sales of US assets that may otherwise be required to generate dollar liquidity, thus reducing amplification mechanisms. So the Fed's FEMA repo facility, together with central bank dollar swaps, appear to have reduced the need of other central banks to sell assets out of their foreign currency reserves to obtain liquidity in dollars to support the funding needs of their local entities. Without access to US dollar liquidity backstops, foreign institutions may have continued precautionary sales of US dollar assets and amplified stress in US credit and other financial markets. The suite of policy actions taken by the FOMC helped stabilize US dollar funding markets. One measure of strains, which is the FX swap basis shown on slide 4, sharply declined over the course of March 2020. The suite of actions that I mentioned also supported the flow of credit to the US economy, as it's discussed in detail in the June piece on the Liberty Street Economics series that I previously showed. So let's turn more now to the more medium term and consider the international networks of banks as potential supports or hindrance to recoveries. For this purpose, think about first the path of economic activity. The global economy experienced an extreme yet common negative, highly negative economic shock from COVID-19. Central banks and governments around the world deployed extensive toolkits in a sharp and ultimately pretty synchronized way. And among the changes that were made were ones that were directly targeted at bank activities. And this included reduced macroprudential buffers and relaxed counterparty concentration limits. Plus, there was a relaxation of borrower-based tools that included allowing a higher loan-to-value and debt-to-income ratio for households and small businesses experiencing temporary financial distress. And this kind of prevalence of how macroprudential tools were relaxed is nicely illustrated in this IMF exhibit by Neer and Olafson. And as we know, fiscal guarantee schemes to support the real economy were also used extensively, delaying or moderating loan losses on bank balance sheets. So this leads to thinking now about asynchronous recoveries and policy normalization. So 1 year later, with news of virus variants and progress on vaccinations, expectations tilt towards asynchronous economic recoveries. The timing and extent of recoveries and the speed of normalization of macroprudential and other policies raise important questions of how international capital flows through banks will respond. So a key question here is whether spillovers through global banks will support local recoveries. So international spillovers. So the global liquidity flows through both banks and non-banks are driven by so-called global factors and local factors, which include different policy tools. Let me just pull this back up. So foreign global banks emerged from the pandemic with stronger balance sheets and could be a source of credit inflows into a broader number of economies, especially if domestic banks end up with a reduced ability to expand their balance sheets and provide lending, Foreign capital flows can support economic recovery. These are some of the themes in these articles that I put up here with Claudia Buch and Matthew Boussier. So historically, positive spillovers through global banks are more likely when these banks are better capitalized and have more robust liquidity. And generally, as I've shown in this top paper with BIS co-authors, better capitalized banks tend to be less flighty lenders and absorb bigger stresses. Now, the International Banking Research Network, which Catherine already introduced, has done work using microbanking data that informs questions about what happens in international flows around changes in prudential policy instruments. The main takeaway is consistent with what I just mentioned. The direction and magnitude of international flows of credit can differ by policy instrument and be influenced by the balance sheet conditions of banks at home compared with foreign global banks. In practice, and I'll just, the lessons, by the way, there's a series of papers that were published in the International Journal of Central Banking, March 2017, and you could see the span of country participants in this one particular initiative, and we've had other initiatives as well. Okay, so now in practice, the spillover effects of changes in prudential measures on cross-border lending can be positive or negative. For example, well-capitalized banks for which tighter prudential requirements are less binding. So if you've tightened your prudential requirements, what happens domestically and to foreign banks? The well-capitalized banks have tended to expand their market shares internationally and lend more internationally than weaker banks when another country tightens. So related evidence comes from Canada's experience and that of Germany and the US. US banks and German banks lending through their bank branches in host countries did not change significantly when the foreign parent country tightened capital requirements. But for banks for both countries, the type of prudential instrument mattered. For example, global banks contracted lending to foreign countries that raised local reserve requirements, while they did not react much to changes in loan-to-value or concentration ratios abroad. Changes in prudential instruments can also shift market shares between domestic and global banks. So studies of Canadian, French, Italian, and Dutch banks point to a positive spillover effect. That is that foreign banks' foreign lending growth tended to increase as prudential instruments abroad tightened. Foreign banks gained market share when requirements tightened, either because they were not directly affected by the stricter regulations or because the regulations were less binding for these banks. And it's the well-capitalized banks that may have used the opportunity to expand their international presence when other countries increased capital ratios and constrained the activities of local banks. So what does that mean for this kind of forthcoming period? It means that as we look to finance, the very important recoveries in all of our countries, the kind of policy spillovers that occur through global banks will be shaped by bank characteristics, the macro environment, and the types of policy instruments that are changed through the trajectory of our normalization and recovery periods. So numerous regulatory and coordination issues are raised by the response of global banks to changes in policy. It's important to monitor these responses for a better understanding of how policies interact with banks' ability to support economic recovery. In some cases, the global banks will potentially play an important role when domestic banks have particularly weak balance sheet conditions and then focus on basically the strengthening their balance sheets and recapitalizing. These could be very complementary paths forward. But monitoring that takes place should make use of the extensive infrastructures and institutions that have been put into place. All of this, looking even further forward, can profit in terms of access to microdata, stress testing frameworks that really have shown their value, methodological improvements in the policy community, but also in the private side on kind of risk management, and certainly on networks of international researchers and established modes of cooperation among national authorities. So that will conclude my remarks. I thank you for your attention, and I very much look forward to hearing the presentations through today. Thanks very much.
Thank you so much, Linda. I think you've really set the agenda in an excellent way. I'm pulling out a couple of themes that I know will be coming up both in the first session, the historical session, and also the more contemporary session later this afternoon. Importantly, the importance of internal capital markets within banks, and there's a lot of research being done there across the 20th century. Cross-border capital flows and that local versus global or local versus foreign will arise in several of the presentations to come. I think this coordination issue and pacing in the asynchronous recovery, but also asynchronous macroprudential relaxation and tightening is a really interesting aspect to be thinking at, and again, can be tested historically as well. And finally, I'd make another bid for the microdata analysis that the International Banking Research Network is doing, but that many of our historical papers are also drawing on historically bank level data, which is more publicly accessible. So thank you very much, Linda. I think we'll move directly on it. We're kind of short for time, unfortunately, but hopefully in the questioning, these themes that Linda will be willing to come back in some of the discussions after the sessions. So we'll move on to the first academic session. And we have two papers on the first globalization, the late 19th and very early 20th centuries, and two papers on the interwar period. So the first paper is being presented by Wilfried Kissling, but is joint with Chris Meissner from UC Davis and Shenzhou Xu from Stanford Business School. So Wilfried, can I invite you to begin?
Yes, sure. I will share my screen. I hope that works. Yes, okay, perfect. Well, hello everyone, also for me. Thank you very much for the invitation. We are very happy to present here today at this wonderful panel. And as Catherine already said, this is joint work with Shenzhou Xu and Chris Meissner. And they would have loved to join today, but 4 a.m. in the morning was a rather challenging time. So they sent their best, but it's only me. So, wait, does that work? So the topic of this conference is risk and benefits of international banking networks. And our paper has a more positive approach. So we're looking at the benefits. And as the title indicates, our central question is, do banks shape international trade? Or better, how much do they shape trade? And the short answer is yes, we believe they do shape trade and indeed quite considerably. So this graph here shows you the world exports and number of bank connections in the world between 1850 and 1913. So what we mean with bank connections is either a sending country has a bank and a receiving country, the other way around, or both at the same time. And by the end of this presentation, I have hopefully convinced you that this positive correlation we can see here reflects the importance of banks in being a decisive force in shaping international trade during the first globalization. And this is our very own data, and I will come back to this a bit later. So we're looking at the first globalization, which was characterized by increasing market integration and by increasing international trade. And the world's leading economy at that time was the UK. And until the second half of the 19th century, what they did, they financed their trade mainly via the merchant banks. But then with increasing trade flows and flows of capital and goods, there was the need for more adequate financial institutions. So the UK started to install their first foreign banks. In addition, the UK was disposing over the central hub and key center, discounting center at this time, London City. And also on top of it, they had the sterling, which was dominating the international markets as a key currency for trade. So in short, or in other words, any competitor in the UK in international trade markets was to some extent quite financially dependent on the UK. And that's why we can see in the second half of the 19th century, countries like France and the US, but also particularly Germany, had the idea to establish their own first financial networks, their banking networks, that would give them the financial independence from London and from the UK, and hence can be an adequate tool to challenge the UK dominance in the international trade markets. But this brings us to the question, do banks actually influence trade? So we know about certain technologies, for example, that have a positive impact on transport costs. We also know that certain institutions and legal frameworks have the ability or the capability to boost international trade. But what seems missing is, in our understanding of the international trade dynamics, is the specific or more detailed role of banks. And if we look at banks, we can roughly say there are three channels through which they might or have the ability to influence trade. The first one being the classical idea of increasing credit, providing credit. The second one by lowering payments and contractual frictions. And finally, they improve information flows and hence diminish information asymmetries. And they do that, as qualitative studies show, by going abroad and providing their customers with detailed information over market conditions, competitors, and so on. So banks being important, banks having the ability to influence trade flows, and banks being an alternative to London, these are the main ideas we want to bring you here, trying to convince you here today. So coming back to the idea of the very first graph of showing foreign banks and trade, this one here compares the world exports of those countries having a bank location, having a bank connection. So the exporting country has a bank in the importing country, or the other way around, or at the same time, with those that don't dispose of a such bank connection. And we can clearly see that the dark blue line is higher, in particular, by the end of the second half of the 19th century, when like France, Germany, and the US started to engage in international banking, we can see the dispersion happening here. So just to point out at this very moment, because I believe we will have a wonderful presentation of this a bit later today, we do not question that London was very, very important in financing international trade. What we rather want to show here, or to convince you and provide new evidence, that disposing over an own international financial network was an additional advantage in the competition in international trade markets. So it completes the pictures. It does not substitute it, okay? Just to upfront that. And the data. So we believe that one of our main contributions, or bigger contributions, is the complete new data set we collected and created. So what we have, we collected all the bank representations in the world on a city level between 1850s and 1913. If you sum it up, that's around about 290,000 raw observations, and we're talking about more than 3,000 unique banks that were present in more than 7,000 unique cities. And we distinguish between two types of bank connections. The first one we call the direct connection, that looks at how many banks of each nationality are in one country. So an example would be how many UK banks were operating in India, and the other way around. And the second one we call indirect connection, and that asks which banks share a country. So, for example, do both India and China have the same UK bank operating? How these connections, these bank connections, influence trade, we're gonna show in our empirical research and empirical approach a bit later. So the data, as I said, has been hand collected from the Banking Almanac, which is an almanac that has been published since the 1815, and I believe it still continues to be published. And it provides information on the location of the bank and the name of the banks. So here you can see an example. In 1891, in Bombay, in the city of Bombay in India, we had several banks, among them the Chartered Mercantile Bank, the Hong Kong and Shanghai Banking Corporation, and so on. What a big challenge was that the Banking Almanac does not provide the nationalities. So what we had to do, we had to assign the nationalities, and we did so by looking at the location of the headquarters of a certain bank. And this information was partly provided in the almanac, but many times we also had to look at secondary literature, such as the famous work of Riese et al. And so on. And so now this should work. And this map shows you all the bank branches in the world in 1871. This one shows you all the branches in the world in 1886, 1900, and 1930. And what we can see here on one hand is the speed of banking expansion. So we're talking about roughly 40 years. So there is a huge boom, in particular starting in 1886, and we can see by 1913, banks were everywhere. What we can also see that in the beginning, we have that concentration of banking in Europe and the UK colonies, but this picture also changes and we have a more diversification in the spread of banks all over the world, but with some, if you want, some particular focus on the emerging countries of Latin America and Asia. And the top 5 sending countries, so those that exported banks went abroad, were the UK, France, Australia, Germany, Canada, and the USA. However, we have to say Canada and Australia are misleading or outliers because they mainly exported to New Zealand and to the US. So what becomes evident also is here that the UK was by far the biggest player, with dominating nearly the whole world at the time in terms of branches. But if we have a closer look at these top 5 countries, on the left-hand side, or the left figure, shows you the evolution of numbers of banks of these top 5 between 1850 and 1913. And on the right-hand side, you can see the very same for the branches. And we do see that the UK is still dominating, but we can see that those countries such as France or Germany are catching up. Okay, so we can see a constant expansion of these. In the matter of time, interest of time, our empirical strategy has 3 goals. We want to see the relation between, or the role of banks in fostering trade. And we look at 3 different kinds of trade. So first, we look at the total trade between countries. Second, we look at the directional trade. So this is exports and imports. And then finally, we look at the third-party trade, which I will explain in a bit. So we start the whole thing with a classical gravity model of trade, which correlates total trade with whether or not there was a banking connection between the countries. So we're talking about any bank connections. And the results confirm that banks do have a positive impact, and countries with a bank connection on average tend to trade 32 log points more than those that don't have such a bank connection. This is a bit more clear visually, I guess. We confirm our results with an event study, and here you can see the vertical line. So these are the global bank and the World Banks and trade for our whole sample. And the vertical line is the bank entry. And we can see that in a moment when in a country, a bank entry, clearly there was this jump in trade. And also what we can see that this is apparently a persistent effect. So not only one time, but it continues over at least 10 years. In the second step, as I said, what we did, we had a look at whether or not we have an influence on the direction of trade. So the first example would be exporter financing. So does Brazil, or does the presence of a British bank in Brazil increase the share of British exports to Brazil? So we're looking at the level of trades. And then we flip the whole thing around and have a look whether or not British bank presence in Brazil also affects imports to the UK. And in both cases, we can see that positive relationship. Indeed, we also have a positive effect on the direction of trade. Sorry, I'm a bit rushing through, but I think I'm very time limited. So finally, what we have a look at, we were interested in the idea, might it be that also banks have a certain influence on what we call maybe regional trade, in the sense that if a French bank, for example, is present in India and in China at the same time, can we see that it affects the trade between these two countries? So the rationale behind that would be that a French bank in India may be more likely to finance an exporter towards China if they have someone in China that can give information about the market conditions and is trustworthy. So it's basically the idea of banking networks creating trust. And indeed, we can also see that this connection, this bank presence, has an impact on this third-party trade, what we call it. We also conduct some robustness checks. The first one being a placebo. So where we have the idea, or the question is, does it matter that an exporter has their own bank in an importing country, or can it be any foreign bank? And we find it has to be your bank. Otherwise, there's no positive significant effect. And in the second step, we have a look at spatial correlations, and we want to know if, for example, we compare the trade between exporting and importing country with the trade between the near neighbors of that exporting country to the importing country, and have a look if our bank effect still exists or persists, and it does. So we exclude the idea that our increase in trade is driven by spatial correlation in that sense. And as I think I'm out of time, to sum up, we present a new data set on the whole entire universe of international banking from 1850 until 1914. And we gave first evidence of this positive correlation, or this relationship between trade and finance, that banks indeed foster trade. So we would say that so far the idea of banks being neglected in that ambition should be taken into account in studying the international dynamics of trade. Thank you very much for your attention. And Catherine, I hope I'm still in time.
You are just in time. So thank you very much, Wilfried. I'm sorry it was a bit breathless. We do have 5 minutes, however, for questions. That's why I was pushing him along a little bit. And if you wanted to ask a question through the Q&A, that would be great. And indeed, we have one already, and I'll announce it for you. So it's from William Allen, and you conclude that trade follows banks, but could it also be that banks follow trade? So a question of causation.
Yeah, that's a very good one. So we are trying to establish this causality. We still haven't gotten there at this very moment. But if you look at the qualitative evidence, if we look at Germany and the Deutsche Bank, for example, when the Deutsche Bank was established in 1871, in the manifest, actually, they concluded that one of the main aims of this bank was to foster trade. So the idea was that banks were established to initiate trade. So we do have some qualitative evidence that it was that banks went where trade was only marginally developed and hence should have a positive effect on it. But obviously it's also, they wouldn't go somewhere where there's no trade potential. So we're still working on that. We're trying to get a bit around with some econometrics, but we still haven't gotten there. What we did a counterfactual, and we could see that there's a positive effect if there's no bank and so on. But it's a very good question. If you have an IV, we would welcome it very much.
Thank you very much. And indeed, remember to post your questions in the Q&A if you have any further. In the meantime, maybe I could ask you about, Wilfried, just to clarify, what do you mean by bank connections? Are you talking about branches or agents, or how are you calibrating those different kinds of relationships?
Yeah, so that was also a very intensive discussion we had. So we are looking at branches. So we're looking at physical presence. So it's indeed when a bank has building up a new bank in another country. Because we thought that agents wouldn't have the same capacity to provide credit and to support the clients as an established bank would be. And then again, it's sometimes very difficult to distinguish between what is an agent and what is a bank, given what the almanac provides you on this information. So for this round, we have focused on the physical presence, but we do know that the correspondent banking also has a big game in it, which would be another project, I would assume. Yeah.
Great, thanks very much. There's a question from Meng Wu, which is the role of the gold standard in your narratives. Does that feature?
When we put it in our gravity model and in our event studies, we put it as a dummy. So we control for it in that sense, in the classical econometrical style that we control it in our equation. So there is some evidence that the gold standard has a positive effect, but.
And from Raphael Heim, do you have a sense of which of the sort of routes or channels through which banks can foster trade and investment are most important, the information asymmetries or what other aspects?
I rushed a bit, but I said it in the beginning. So we defined these three channels. Now that's providing credit and by diminishing the information asymmetries and providing information flows. So we can't pinpoint down which of the three it is. So we have to, we don't have any information on what exactly the banks did on the ground because we have all the banks in the world. There's 270,000. So it's just, would be a big challenge. So at this point, we are going for one of these three, it should be. But it would be very interesting. We are also on it to try to disentangle a bit.
Okay, thanks very much. We have some questions still outstanding, but I'm going to leave them in the chat, and maybe you could have a look at them, Wilfried, and we'll try to get back to the questioners. And I think we'll. So thank you so much for a really interesting intervention. We next have up Olivier Accominotti from the London School of Economics, and he has a paper joint with Stefano Ugolini, Delio Lucchesa Piquero. So Olivier, are you there?
Yes, I am.
Okay. So we're staying with the sort of, late 19th century, early 20th century, and again with the sort of architecture of the global payment system, looking at bills of exchange.
Good. So let me share my screen.
Okay. And 15 minutes, Olivier.
Yes, I will try to keep the time. First, thank you so much for inviting me to this great conference. So as you said, this is joint work with Delio Lucena Piquero and Stefano Ugolini. And Stefano is actually with us today, so he can participate in the discussion afterwards. So since you asked me, Catherine, to participate in this conference 1 year ago, the paper I was planning to present has been accepted for publication. However, that paper is part of a bigger research project on the global money market during the first globalization. So what I'm gonna do today is present some results of the accepted paper as well as new and more preliminary results of a follow-up paper we are currently working on. So, a question we are all interested in here is how resilient is the international banking system? And this question, of course, has come to the forefront since the great financial crisis, when we realized that problems in the global money market and the failure of small but highly interconnected financial institutions could have far-reaching consequences for the global financial system. And what we are trying to do in this project is to put these questions into a historical perspective by analyzing the global money market at the height of the first globalization, so in the early 20th century, right? At that time, the pound sterling was the global currency. London was the world's international financial center. And the London market for sterling bills of exchange in particular was the main platform for international short-term lending and borrowing. So it was really the global money market. So our aim in this project is to use the tools of network analysis in order to analyze the functioning of the global money market before the First World War. And we have two main questions in mind. The first question is, how was the pre-World War I global money market organized? How was it structured? How did it work? And then the second question is, how resilient was this market to financial shocks, right? So these are the questions I'm gonna focus on today in the presentation. So what I will do is first give you a little bit of background on bills of exchange and how they worked. Then I will briefly talk about our data and sources. In a third part, I will present a set of descriptive findings on the organization of the London money market in that period. And finally, I will present the more preliminary results we have produced on the resilience of this market to financial shocks. But let me start first by clarifying how the money market worked by then, right? So as I said before, the main instrument used for money market transactions at that time was the sterling bill of exchange. So what was a sterling bill of exchange? Well, it was an instrument of private short-term credit, which was used by firms and merchants all over the world in order to finance their activities. And when we talk about bills of exchange, what is really important to keep in mind is that it was a very flexible instrument, which could be used in a variety of ways. Its main use was for trade finance. However, it could finance other types of activities, especially financial operations such as security investment, currency speculation, and etc. So it was a very flexible instrument. At the same time, however, there was one common thing to all bills, which is that they always involved at least three agents. First of all, the drawer of the bill, so the person who addressed the bill and who was the money market borrower. Second, each bill had a so-called acceptor. The acceptor was the agent who guaranteed the payment of the bill at maturity and therefore was a debt guarantor. And finally, each bill had a discounter. The discounter was the agent who purchased the bill and was therefore the ultimate lender, right? So you can see an example here. It is a bill which was drawn by a firm in Moscow in August 1910 on London, so a sterling bill. As you see, it's denominated in sterling. And you could always identify the three agents from each bill. The name of the drawer appeared always on the bottom right. The name of the acceptor, again, the debt guarantor, appeared on the bottom left. And finally, the names of all successive discounters of bills appeared on the back of the bills, right? So what we are interested in here is to understand who these drawers, acceptors, and discounters actually were on the London money market before the First World War. And then also we want to know who was connected to whom through these bills of exchange, right? So in order to document that, the main source we use in this project is an archival source, which is the Bank of England's discount ledgers. The Bank of England indeed was a big player in the London bill market. It purchased a large number of bills as part of its monetary policy operations. And also the bank reported systematic information on all bills which it purchased. And in particular, it reported the name of the drawer, so the borrower and their location, but also the name of the two London intermediaries involved in the bill, the acceptor, so again, the debt guarantor, and the discounter, the ultimate lender, right? So what we did here is to collect that information for all individual bills which were purchased by the Bank of England in the year 1906. We choose the year 1906 for reasons I can explain later on. So there are more than 23,000 bills for 1906. And we use this data to reconstruct the network of agents which were involved in the origination of these bills, right? So especially we record all links between agents who appear on the same bills, right? So we look at relationships between drawers and acceptors, relationships between acceptors and discounters, and finally, we also look at the more indirect relationship that existed between a drawer and a discounter, right? And that's how we build our network, right? So now a first thing we can document with this data is where the borrowers on the London money market were located. So this map shows here the geographical distribution of money market borrowers in 1906. So the drawers of bills, right? And as we see clearly on the map, borrowers through sterling bills originated from across the whole world. There was very wide geographical dispersion, which clearly shows that the London money market was a global money market at that time, right? So you really had firms and merchants from everywhere in the world who borrowed on that market, right? And of course, this wide geographical dispersion raises the question of how these borrowers were being screened, right? Indeed, the average investor in London typically had very little information about foreign borrowers. So there must have been substantial informational asymmetries between lenders and borrowers on that market. And what we argue in our paper is that money market intermediaries played a key role in solving these informational asymmetries so as to allow lending to take place. And the main role here was played by the acceptors of bills. So as I said before, the acceptors were the guarantors of bills of exchange. They guaranteed the payment of the bills for their domestic and foreign clients in exchange for a fee, right? And when consulting the archives of the main acceptors in the London city, who were the London merchant banks, we realized that these agents specialized in gathering detailed information about money market borrowers abroad. So there was a special relationship that they developed with firms abroad who wanted to borrow on the London money market. And we can see that in our data as well. And in particular, what we observe in our data is that drawers of bills, so borrowers, again, on average had much fewer acceptors than discounters, which suggests that there was a special relationship between drawers and acceptors because the latter held private information on the former, right? So to show this, we look at the distribution of drawers of bills and we classify them according to whether they had more discounters than acceptors or fewer discounters than acceptors. And then we compare this distribution to two sets of simulated networks in which links between agents are formed purely randomly, right? And what we see in the table is that there was about 50% of the drawers in our data who had more discounters than acceptors. By contrast, if links between agents had been formed purely randomly, as in our simulations, less than 5% of the drawers would have had more discounters than acceptors, given the demography of our network, right? So what this suggests here is that there was clearly something special about the relationship between drawers and acceptors, and this pattern is typical of relationship lending markets, where banks hold private information about their customers, right? So acceptors played an important role, but then, of course, then their role was also complemented by that of the discounters. Indeed, a legal rule on the London bill market was that every discounter of a bill of exchange was adding a secondary guarantee to the bill, in addition to that of the first guarantor, the acceptor, right? So in our data, actually, we identified two types of discounters. First of all, there were so-called discount houses, which were institutions which worked a little bit like money market funds nowadays. They took short-term money from clients in order to invest in money market instruments, and they obtained their bills mostly directly from the UK acceptors. So here, their role was to screen the acceptors of the bills. And then on the other hand, you had the multinational banks, also called Anglo-foreign banks, which mostly obtained their bills from their foreign correspondents or the branches in the countries where they were specializing. And we can see this. Yes, perfect. So we can see this distinction here between the two types of institutions. So here you have the discount houses, again, which very much look like money market funds nowadays. And here you have three multinational banks. And what we see clearly that whereas the discount houses' portfolios of bills were geographically diversified, what we see that the multinational banks' portfolios of bills were highly skewed towards the regions where they specialize. So, you know, North America for the Canadian Bank of Commerce, Latin America for the Bank of Tarapacá and Argentina, for example. So in that case, it looks like the borrowers had been screened locally by the multinational bank's foreign branch or foreign correspondent, right? So, you know, overall, what we see that the organization of the money market was quite complex, right? With all these different types of actors doing different types of activities. And there were many ways through which the bills were screened and could eventually find their way on the money market. However, what we see as well is that intermediaries in London appeared to have played a crucial role in solving informational asymmetries and allowing lending to be sustained and allowing for the robustness of the market, right? So now that we have described the organization of the London money market, the next question we want to address is how resilient was this network to financial shocks? And in order to address this question, we perform network simulations again to measure the effect of an intermediary's failure on the whole money market network, right? So concretely, we measure the impact of removing individual intermediaries on the whole network, and we look at how many agents lose market access when one intermediary is removed, right? And the preliminary results we have obtained so far is that the network appears to exhibit stronger resilience than modern interbank networks, where typically you have a few institutions at the core who are highly systemic. On this graph, for each intermediary, you have, its total impact rate, which is defined as the share of agents who lose market access if that intermediary is removed from the network. And what we see that there are very few intermediaries who are highly systemic. There are only two institutions here, one discount house and one multinational bank, whose failure would have resulted in a loss of market access for more than 4% of agents in the money market, right?
Thank you. Can you go to your conclusions?
Yes. So I'll go to my conclusions. I'll skip that. Basically, to summarize, as I said before, what we're trying to do here is analyze the structure of the global sterling money market before the First World War. What we find is that there was a great variety of borrowers and also a great variety of ways through which the bills could be originated and distributed. But intermediaries played a crucial role in resolving informational asymmetries. The money market network that we observe appears to have been more resilient than modern interbank networks, and there may be some policy lessons here. And indeed, the liquidity of the London money market was only questioned once in our period, which is when you had one big exogenous shock, which was the outbreak of World War I, which really puts into question the solvency of many intermediaries, right? But we believe that the structure of this market probably explains its robustness during the first globalization. So I'll end it here because I'm out of time and I'm looking forward to your questions.
Great. So we do have time for a few questions for Olivier. If you can post them in the Q&A button, I'll read them out. In the meantime, can I just ask whether, reflecting on your data sample for the first part of your analysis, the 1906 Bank of England discount ledger, whether there might be a bias or a selection problem because they might maybe have higher quality acceptors than the general market?
Yes, of course. It's a very important question. So we try to address that. There could be two types of biases, right? It could be that they were more cautious than other discounters on the market, and therefore they had higher quality bills. But it could be the opposite as well, right? Given that they had a discount window, it could be that the money market participants try to unload their worst quality bills to the Bank of England because they could, right? So what we did is to compare the bill portfolio of the Bank of England with the portfolio of one major discount house, which is Gillette Brothers. We do identify some biases, especially what we see that the Bank of England had a bias against foreign banks, the foreign branches of the branches of foreign banks. But we don't find huge biases either, and we don't find huge quality biases in particular, right? The main bias we find is this discrimination against foreign banks, which appears to have been strong at the Bank of England. Yeah.
Okay, and just one quick follow-up. Mele Savaro is asking, why 1906? Is that just serendipity, or is there? I know that there's a crisis on the way, but why 1906? Yeah.
So the thing is, if we had more money, we would have just collected data for all years, but that's very tedious. So we chose 1906 because you need to have a year where there is substantial activity at the Bank of England's discount window, because you need to have as many bills as possible, right? At the same time, we wanted to avoid years where you had a full-blown financial crisis because of possible selection biases, right? So eventually we choose 1906 because you have a lot of money market activity of the Bank of England in that year. At the same time, there is no full-blown financial crisis in the city. So, we thought it was a good year to choose, right? the next step in the project may be if we get funding to extend that to more cross sections.
Thanks very much. Thank you very much for a fascinating paper, Olivier. And we'll move on now to Mark Carlson from the Federal Reserve Board. Mark, are you there?
I am here.
Great. Okay, so we're moving into the interwar period, and Mark will be looking at cross-border capital flows and the Great Depression for the US.
All right. So thank you so much for inviting me to participate. This is a fantastic conference. And I'm delighted to talk about this paper, Domestic and International Crises in the Early 1930s and Conditions in the US Money and Treasury Bond Market. This is very preliminary. I'm looking forward to all comments and suggestions. The standard disclaimer applies. These are my views and should not be interpreted as reflecting the views of the Board of Governors of the Federal Reserve or its staff. Okay, so let me start by sort of framing the motivation for this paper and then give you a little bit of a sense of where I'm going to be going. So there is some debate in the literature about the extent to which developments abroad, especially in Europe, affected financial and economic conditions in the United States in the early 1930s. To oversimplify a fairly large literature, one path for the international transmission, as described by Eichengreen, Temin, and others, is through the gold standard. In this case, crises in Europe, first in Germany, and then in the United Kingdom, gave rise to concerns about the US commitment to gold. So the Fed then tightens policy in response to the resulting outflows in flight from the dollar. The tighter monetary policy then causes problems in the US. Some further evidence that there was transmission from Europe to the US is from Rickstall and Sabaras, who find that financial distress, especially in the banking sector in Germany, did affect the US. However, papers that have looked sort of in a very detailed way at the institutions who are most likely to be affected by financial shocks originating abroad, which would be the New York City banks, which had the largest foreign exposures, find that there's no real impact on these banks or their behavior from developments in Europe. And so that casts some doubt about it, whether there's any sort of direct connections. In looking at all of this stuff, there's also good reason to think that there may have been, what was going on in the US was very highly domestically focused. There was a number of banking panics in the US, especially in 1931. And so any sort of analysis of what's going on has to take careful account for what's going on in the US itself. And so what I'm going to try to do in this paper is look at this well-traveled question yet again, but I'm going to use some new data, some fairly high frequency, which in my case is weekly data, to examine whether conditions in US money and treasury markets were affected by international financial shocks. And so in the course of the presentation, I'm going to talk through some of the description of the exposures to New York City from foreign and domestic factors. I'm going to present some statistical analysis. What I'm going to try to look at, what is the role of international factors, what is the role of domestic factors, and also try to account for what's going on with monetary policy and look at how these things are affecting conditions in these two financial markets. And what I'm going to find is that international developments did indeed, or at least suggestive evidence that foreign developments left an imprint on US markets. So let's start by talking about the presence of foreign investors in New York City and the exposure to international factors. So during the interwar period, New York City becomes an increasingly important financial center. This table presents the holdings of short-term liabilities by investors from Europe in US or either in US banks or in US short-term instruments that were sort of in custody accounts at New York banks, including the Federal Reserve Bank of New York. And you can see that on the left is the holdings of short-term liabilities by the foreign investors. And the remaining columns here, I'm trying to give you a sense of the size of the different money market assets in the system, and as the total is on the far right of the table. And you can see that holdings of short-term liabilities by foreign investors, sort of through these international connections, were a fairly sizable, represented a sizable portion of the funds invested in U.S. money markets. Let me say just briefly a few words about the acceptance market. This market had grown rapidly in the 1920s. A significant portion of this market was linked to foreign trade or activities abroad. And when I started this project, I thought this market was going to be a very key part of the story. And it may be part of the story, but at least as far as I can tell, it was not key. I haven't quite figured that part out completely yet. And so I felt I needed to mention it, but I'm not going to discuss it any further in the talk today. All right, turning to domestic factors. So the banks in New York City had long been central to the US money and financial markets. Banks across the US had held balances in New York City for decades. These were useful in clearing payments and meeting reserve requirements, investing in securities markets. They were funds that reflected their ability to borrow short-term funds. With the introduction of the Federal Reserve, the importance of these balances diminished, but they certainly were retained by a number of banks across the US. And so during the banking panics, some of these deposits would have been withdrawn by the banks that needed the funds back at their home office. And so there was a fair bit of deposit flight during the panics that would then have strained New York City banks, and those withdrawals of funds from the New York City banks could then have been passed on to the money and treasury markets. So those sort of outline the mechanisms that I'm going to try to look at when thinking about what is driving conditions in the money and treasury market. So in order to do this, the formal analysis, I need measures of conditions, both in the money market and the treasury market. So for the money market, I'm going to consider the spread between 90-day commercial paper, the rate on that paper, and the federal funds rate. So commercial paper were short-term loans to high-quality, medium-sized businesses. The commercial rate is the rate at which banks or other financial institutions would buy this money market instrument. And the 90-day rate was a fairly common maturity for this paper, so that's what I'm going to look at. The federal funds rate is the rate at which banks, mainly in New York City, would be borrowing from or lending to each other, typically overnight. This is very recently collected data by myself, as well as Dave Wheelock, Chris Haynes, and Surya Amble. And it's going to be very helpful to try to measure, to think about the conditions, right? So now we have a 90-day rate versus an overnight rate. So you can think about the conditions in money market being related to a term spread. This spread could also reflect the intermediation spread. So banks are lending to the commercial paper, and they're able to obtain funds at the federal funds rate. It could also reflect a credit risk to the extent that these commercial paper borrowers are more risky than the commercial banks that would be borrowing federal funds. But I'm going to hope that doesn't change too rapidly over the course of a week, say, and that these first two parts are the driving factors. So to measure what's going on in conditions in the treasury market, I'm going to look at the spread between the bid price and the ask price for treasury bonds. Treasury bonds are the most liquid part of the longer term market at this point. The treasury securities were an important secondary reserve, so we would also expect to see stresses materialize here. This spread is going to be a much cleaner measure of market functioning. And so I think looking at this is going to be a nice complement to what's looking at money markets. For both of these, I'm able to compute daily spreads, and I'm going to average those over a week to align with the other data that I have. All right, so those are two important building blocks. The next building blocks I'm going to are the indicators of stress. So for the indicators of international stress, given that the source of the stress is going to be pressures on the dollar and and concerns about whether the US would abandon the gold standard, I'm going to look at compare the spot rate to the forward rate of the dollar relative to another currency. I'm going to pick the country with arguably the strongest commitment to gold, which is France. And so concerns about a devaluation should lead the spot rate and the forward rate to deviate sharply. And I'm going to use the same measure that's used by Say and Romer in their study of this period. So domestic stress is going to be indicated by weekly closures of non-New York City banks. Chris Michener and Gary Richardson have some papers who look at what happens when there were bank closures, and they find that these closures were associated with withdrawals of funds from New York, and that could be because of funds drawn down by those banks that were closing, but also because of nearby banks who then felt the need to gather liquid resources locally in order to meet potential runs on. And Gary and Chris have kindly shared the data with me.
4 minutes.
Perfect. So the final building block is the Federal Reserve. So I'm going to look at actions by the Fed to change monetary policy. So both this could be the interest rate at which banks could borrow from the Fed, which is referred to as the discount rate. And there's also the change in the rate at which the Fed would purchase acceptances. The other thing I'm going to account for is bank borrowing from the Federal Reserve. So this is one way that banks might prevent stresses from affecting money and treasury markets. So in the analysis, I'm going to use a vector autoregression, and this is going to allow each of these building blocks to influence each other one, just with a lag. And I'm going to use a specification with 2 lags of each of the variables. I have weekly data from January 1929 until December 1932. And so these are the impulse response functions from the vector autoregression. And so in the upper slide of panels, I apologize that they're a little fuzzy, but you can see what's the one to the far left is the response of money market spreads to a shock to monetary policy. And so you can see when the Fed tightens monetary policy that tightens conditions in this widens out the spread between the commercial paper rate and the federal funds rate. You also see from the middle panel that there was a tightening or the widening of this money market spread in response to concerns about expected devaluation, which is consistent with this idea that international shocks were transmitted to US money markets. In the final upper right chart, you see that there's not really any response to bank closures, which was surprising to me, and I'm still trying to understand why that would be, because you would very strongly expect that there would be an impact here. If you look at the bottom row of charts, you see that this is the same, but this is just for the treasury market. And so you can see in the bottom left, the bid-ask spreads in the treasury market do not respond to changes in the discount rate. This may be, it may well be the case that the level of bond prices moves, but just the bid-ask spread did not widen. The middle chart, in the middle lower, you see that there was a response in bond spreads to expected depreciation. So that suggests a deterioration in the condition of the US bond market functioning in response to concerns about devaluation. And then finally, you also don't see a response of the treasury market to developments in bank failures. All right, so this is suggestive evidence that there was transmission from international shocks to depreciation. And then I would like to briefly talk about some evidence on a mechanism by which this occurred. So one channel in particular might be because what I'm going to look at is whether there was an impact on the balance sheets of some of the New York banks. I'm in particular going to look at whether there was a change in their lending on securities collateral, which was the main vehicle by which they provided funds to the US money markets. So I'm going to look at the stresses on their lending, and then I'm going to look at whether the lending then affects money market spreads. And I find tentative evidence that these linkages mattered. And so that's shown here. So the first column 1 shows the responses in lending on securities to the various shocks. You can see in lines 3 and 4 that there's not so much of a response to bank suspensions, but there is, as shown by lines 5 and 6, that when there was increasing concerns about devaluation, that there was less lending on securities by New York banks. And you see in column 2, this second step in this mechanism, whereby if there was a change in lending by securities, that had an impact on this money market spread that I'm measuring. And so if you just walk through these different parts, you see that an increase in concerns is going to reduce lending. Reduced lending is going to lead to a wider spread.
Maybe move to your conclusions, Mark.
And there we are. So just to summarize, we find evidence. So this paper is taking another look at international bank connections, their impact on conditions in New York financial markets. So I find pretty clear evidence of an indirect effect sort of through monetary policy. The Fed tightened in response to expected concerns about the dollar. That seems to be transmitted through to financial markets. I also find some evidence of conditions affected conditions in money markets through bank balance sheets and their willingness to lend into these markets. So thank you. That was what I had to say.
Great, thanks very much, Mark. A really interesting paper and a quite well-trodden question. So you're finding new evidence for the sort of transmission route for those cross-border flows. Just maybe while I'm waiting for questions to come up in the Q&A box, your original data showing the relative size of foreign and the domestic money markets. It was as of December 1929, and I wonder why you had chosen that date, which is, of course, after the September or the October.
So actually, you see, it's interesting that you see foreign exposures are still increasing through this time, and it's really not till some of the European crises that emerged in the 30s that you see that foreign investment in the U.S. Diminishes. So I was actually kind of surprised that you don't really see a decline in foreign investment following this following this sharp shock to the U.S. stock market, and I was quite expecting that there would be a decline, but you don't see it. It doesn't. If I were to use like 1928 or 1927, you actually get a fairly similar picture in terms of the relative size of foreign investment compared to the size of these different money markets. And so, since I wanted to talk mostly about this sort of 1931 event, having something closer to that point seemed helpful.
Excellent, thanks very much. So questions for Mark? I wondered if you wanted to pull yourself a little bit forward. Are there implications in this for how we understand the impact of cross-border flows on sort of the transmission through securities markets, as well as the kind of traditional route that you wanted to highlight?
So I guess the sort of the one thought I have is sort of each time I go digging to try to understand sort of foreign the level of money market borrowing or money market lending that occurs internationally, it's always larger than I think, and I think you see that here, where this is a really large share of the size of the foreign investments in the U.S. is actually a fairly large share of the outstanding amounts of U.S. money market securities.
William Allen is wondering, do you know how much of that is from foreign central banks rather than banks?
I think a significant portion of it is foreign central banks. So parsing that out would be a little hard. You do see sort of foreign central banks will have placed deposits at the Federal Reserve, and so you can separate that out. It may still be the case that those foreign central banks also place money with private U.S. banks for some reason, but you can get a little bit of a sense of that. I think there's a table in the paper that would let you take a look at that, but I can't remember exactly what the numbers are offhand.
Okay, thanks very much, Mark. And I think we'll move swiftly on to our final paper for this session, which is Natasha Postel-Vinay and Stephanie Colette. Natasha is from the London School of Economics, and Stephanie has now moved to the Deutsche Bundesbank. So again, we're still in the interwar period, but it's slightly earlier, and looking at the accumulation of fragilities in the German banking system.
So thanks very much for inviting us at this conference. So as we just said, this is joint work with Stephanie Colette, and she's with us today, and so she'll be able to participate in the discussion, which is really nice. We're really glad to have an opportunity to present our work for the first time. So the work is really quite preliminary. I just want to emphasize this. Okay. Yeah, so the question that we ask is, do hot capital inflows cause bank risk-taking? And this is an interesting question, we think, because we live in an increasingly interconnected financial world. But also, there's been lots of crises in Latin America, in East Asia, in the Eurozone, that seem to have been very often preceded by sudden capital inflows. Unfortunately, in our view, in some ways, a lot of debates about the causes of these crises have often set sort of the international factors on the one hand against more domestic factors. And this is in some ways not so true of third generation models that have really tried to look at the interactions between international factors and domestic factors. But a problem with a lot of these third generation models is that they really focus on the dynamics of the crisis, and the focus on sort of really what happens when the crisis occurs, and the combination of, banking crisis and currency crisis, but they don't really look at sort of what happens before the crisis and whether there may be international factors that sort of expand risk-taking and bank risk-taking in particular in the years preceding the crisis. Have been papers looking at those interactions, such as by Diaz Alejandro, but there's actually been little empirical evidence on the question. So the question we ask here is, can we learn anything from 1920s Germany? I'm pretty sure that I won't surprise you by saying that Germany is a pretty contentious case in the interwar period, with on the one hand, many authors saying that the causes of the crisis are not really a problem with the domestic banks. They're more to do with foreign investors and fiscal issues and foreign investors suddenly withdrawing their funds. And there's others who've been emphasizing the fact that lots of domestic banks took a lot of risks, and so emphasizing both sort of the banking crisis aspect as well as the currency crisis. But in some ways, this literature hasn't really systematically looked at the impact of foreign inflows on bank risk-taking before the crisis. And so that's what we're really interested in. There's been some implications in the literature that there may have been impacts of foreign inflows on bank risk-taking, for example, in Richel's work, but we want to sort of have a more a quicker look, a deeper look at what's going on in the banks. Now, a problem with this is that we face two empirical issues. If we want to look at the relationship between inflows and bank risk-taking, first of all, there's going to be an endogeneity issue because, yes, it's true, inflows may affect risk-taking, but on the other hand, bank behavior can also affect inflows, right? A more aggressive bank risk profile, for example, will seek to attract more inflows. So that's the first problem we need to deal with. A second problem we've got in our data is that data on foreign liabilities is actually quite patchy. So the 1920s deposit data that we have does not explicitly separate the two, the foreign from the domestic deposits. On the other hand, though, we do have data on 1930 foreign liabilities. And so we can probably find solutions about this, and I'm going to talk about them now. So what's our approach? Our approach is a combined panel and instrumental variable approach in 3 steps. So first, we explore the relationship between 1930 foreign liabilities and deposit growth in the 1920s. And from this, we extract the relevant deposit types, right? And then in a second step, we run our panel analysis by regressing the risk change on relevant deposit change over time. And of course, we need to mitigate endogeneity. And the way that we do this is that we include only the months in which the US-German interest rate spread falls. And that's similar to what Dinger and Takat do. Now, in a third step for robustness, what we do is we conduct an instrumental variable approach in the pre-crisis cross-section, which I'm going to detail a bit further down below. But our instrument is going to be initial bank size, and we're going to try and justify this in a moment. We also think that a main contribution of our paper is that we've got a new data set. So we hand collected data on the evolution of banks' balance sheets from 1925 to 1938 in Germany. The focus is on 1925, 1930. We've got about 130 banks, so that's 9,000 observations. The data is from the DRPS. And we make use also of data very kindly shared by Stefan Luck and his co-authors on 1930 foreign liabilities. So this is the data from DRPS. Now, what do we find? We find that foreign inflows are a strong predictor of leverage, loan growth, and bad loans. Not such a strong predictor of changes in liquidity. The issue does not seem to concern only the big Berlin banks, so that overall capital inflows are not just a mismatch and withdrawal risk, but also seem to have induced bank risk-taking. Okay, so now just to give you a little bit of context on the post-Dawes Plan debt boom, what the literature says. First of all, it does look from reading the literature that bank risk-taking did seem to expand in the 1920s, right? So after the 1923 hyperinflation, banks underwent a dramatic expansion. And this expansion went hand in hand with risk-taking. Of course, we don't know whether this is causal or not, but at least we know this happened. We know that liquidity fell. We know that capital ratios fell dramatically as well. So that they were a significant issue. We also know that there was a lack of asset diversification at the banks. There was overlending to municipalities, and there was lack of asset diversification more generally. Lots of banks were lending to single borrowers that they knew and they had known for a long time, so that there was overinvestment in specific types of industry. Now, if we ask about the causes of bank risk-taking, clearly, it looks like the structure of the German economy may have played a role. So it looks like banks were over-investing perhaps in sunset industries or maybe in the rationalized industries. There's a little bit of a debate about this. Strong competition and lack of banking regulation seems to have played a role as well. And even though Reichsbank policy was overall quite restrictive, at times it was looser, and so that may have played a role as well. Now, what about bank risk-taking and foreign inflows? This hypothesis has never really been systematically explored. It's implicit, though, in quite a few accounts. And there has been quite an increase in loanable funds at the time. In foreign loanable funds, actually foreign deposits increased by a factor of 7.4. The interesting thing theoretically is that a sudden foreign inflow can act like a sudden domestic increase in loanable funds, right? So that pushes banks to take more risks. Now, it's true that there were some demand factors, right? Demand factors may almost certainly play a role in the foreign inflows. And these are the ones that we're not really interested in, right? So there was strong demand for funds following hyperinflation because there was a huge capital shortage. And monetary policy may have also spurred demand, although I won't go into the details here. And tax avoidance probably played a role as well, as has been documented by Harold James. Now, what about supply factors? These are the ones that we're interested in. Supply factors seem to have dominated long-term gross lending. So that's long-term lending. It's not really what we're interested in, but that's, you know, an interesting piece of information in itself. That's in the work by Olivier and Barry Eichengreen. We also think that's very much talked about in the literature. The Dawes Plan seems to have really contributing to boosting supply. And as a result, and this is something you really see in the data, interest rates really fell from the 1925 peak. How did banks use these foreign inflows? Well, some of the inflows seem to have been directly linked to foreign trade. And that was the case at least initially. So very often these were, linked to the lines of credit on foreign banks that we've been talking about, the trade acceptances. On the liability side, these appeared as liabilities for clients, and they were secured by trade goods deemed to be self-liquidating. A problem with this is that over time, these liabilities for clients were increasingly made for other loans, for often uncovered and non-trade loans, and this is thoroughly documented by Balderstone. And eventually, actually, a lot of the foreign lending was done through simple deposits, and these were unconnected to trade, and they were usually 3 months maturity and in foreign currency. So this is data that shows you the difference between these liabilities for clients linked to trade acceptances and the foreign-owned deposits. Okay, so what's our empirical approach? So I've already mentioned the 2 challenges. And I've mentioned our solution in 3 steps to extract the most relevant deposit types, the panel analysis, and the instrumental variable approach in the cross-section. So let's try and extract these relevant deposit types. So the nice thing about the 1930 data on foreign liabilities, which is about the banks that had the highest shares of foreign liabilities or foreign debt in the German banking system that were required to report to the Reichsbank. There were about 22 banks within this sample. And we can see that these banks really expanded. So they're called here, they're miscalled foreign banks. They're not foreign banks, but they're the sort of foreign inflow banks. And these saw the largest increase in trade deposits. So these liabilities for clients here that I was just talking about, relative to the other banks. And these banks also saw a huge increase in 3-month deposits here relative to the other types of banks. And this is not true for the other types of deposits. So not true for 7-day deposits, where there's not much increase at all. These are indices. And not true for due-to banks either. So that means we can focus on these trade deposits and 3-month deposits. Incidentally, if we have a look at these nice graphs of just trying to differentiate between these 2 types of banks, we can see that quite clearly these banks had a capital to total asset ratio that was falling quite dramatically over time between 1925 and 1930. They also made more uncovered trade loans. They participated more in the stock market, and they had more short-term loans. Now, what do we do in the panel analysis? So we look at the months in which the spreads in interest rates between Germany and the US fell. So these are our 3 periods here where these spreads fell. The 2 most important lines here are this one and this one. The other 2 are just sort of the Reichsbank discount rate, which we can see, by the way, fell a lot less than the spreads in these other rates. So we use these periods, and what we end up having is a nice panel regression of liability growth of changes in total capital to total assets and loans to total assets on liability growth in the short term, 2 months, in the long term, 6 months, with some controls. And we can see nicely that liability growth, as we expected, does decrease the capital to total asset ratio, but also actually increases loans to total assets at these banks. If we look at these scatter plots, we've been trying to explore a little bit the relationship for different types of banks, so the Great Berlin banks, other banks, the credit banks, the Staatsland banks, the Eurozentral. And I wish I had the time to go through all of this. But what we can see is that the relationship is strongest at the credit banks and not so much at the Eurozentral and Staats- and Landbanken. Now, what do we do in our 3rd step? As a robustness, we look at the pre-crisis cross-section at February 1929. And what we do is we regress risk-taking, so capital to total assets, say, on foreign debt as a binary variable. As I said, there's a little bit of a caveat here, which is it's only 22 banks in this category, right? But we know these banks really had the highest share of foreign debt in the country. We use initial bank size as our instrument. Now, why this instrument? Well, bank size can be a little bit controversial, but at least in terms of relevance, it's definitely not controversial because we all know that larger banks attract more inflows. Now, in terms of validity, this is why it's controversial, is because nowadays you would always say that larger banks, take more risks. Why? Because they are too big to fail, right? So the too big to fail means all sorts of things which entail, in the end, further risk-taking. So all of this hinges on whether there was a too-big-to-fail environment in the 1920s already. Now, Schnabel has argued for the presence of liquidity guarantee, and that was linked to the credit stop in 1924, which I won't go into. Unfortunately, I don't have time.
So, Natasha, we're down to the last minute or so, so if you wanted to leap to conclusions.
Yes, sure. Of her own admission, this is slightly speculative. And in fact, I will argue that, we will argue actually that this was the gold standard era. And so the banks, as everybody knew, the Reichsbank had a very significant conflict of goals, which meant that the Reichsbank basically could not at the same time save the banks and save the currency at the same time. And surely the banks were all aware of this. And so this implicit liquidity guarantee hinged on the severity of any future currency crisis. In addition, there is no concrete evidence at all of an implicit bailout guarantee, which Schnabel totally admits. So that means that perhaps the idea of a too big to fail environment is slightly anachronistic. That's my own timer. These are results from the IV analysis, and we can see that the first stage is definitely all right. And we can see indeed that being a foreign inflow bank significantly reduces your capital to total asset ratio. It reduces your liquidity ratio, but by less, right? So the most of the action is in capital to total assets. Conclusions. Our results suggest that foreign inflows are a strong predictor of leverage, loan growth, bad loans. The results are less strong for changes in liquidity, but overall we can say, I think with quite certainty, that capital inflows are not just a withdrawal and currency mismatch risk, but induced bank risk-taking in the period before the crisis. Now, just to caveat, the results are very preliminary. We need to deal with mergers, takeovers, bank types. We need to explore dynamics further, add more controls, other variables. We need to explore different spreads in different countries. And we need to explore crisis and post-crisis dynamics, since we've got data up to 1938. Thank you.
Excellent. Thanks so much, Natasha, for a really rich paper indeed. Thank you for rattling through so quickly. I have a question from Linda Goldberg, who wonders, while inflows might have led to increased risk-taking, as you say, could this be interpreted as a positive development given the initial lack of diversification and the set of positions in sunset industries?
Let's Stephanie,
how you're defining
Stephanie wants to answer this. Is she here? Is Stephanie here? Maybe she's not. Okay. Stephanie,
it's about how you're defining risk-taking, and maybe
it's a good question. It's a good question. I mean, you could see, so to some extent, for sure, banks were short of capital, and so they needed to expand, right? So expansion is not necessarily a sign of risk-taking at all. If it was just expansion, it would be fine. But I guess what we see is really a difference between the two types of banks, right? So all types of banks expanded massively, right? But there were just some banks that in this expansion phase were a little bit more careful and didn't decrease their capital ratio as much as the others. Although, Linda, you're right, there was actually a fall in leverage, an increase in leverage among all types of banks, actually. It's just that this was a little bit more pronounced at the banks that seems to have received more inflows. And I really don't think that this could be seen as a positive thing, but maybe we could have further discussion about this.
Thank you. So Nectario Saslanidis wanted to know how many banks you have in your sample and why you're using random effects instead of fixed effects in your panel regression.
Do you want to go ahead, Stephanie?
So we have 137 banks, and we just did the Hausmann test, but it's pretty much the same results that we go for one or the other.
Excellent. I had kind of a question, just sort of from the historical context and to make sure I understand. I think of this as a kind of a period of great maelstrom, both in prices and the exchange rate and monetary stabilization and other sorts of things going on. So I'm almost surprised there's so much foreign deposits and that they're increasing 7-fold. Is there an exchange rate element in here that how you're measuring them, or is this real increases?
I think that's a really good question. We could investigate a bit more on this, but like we have the value that it is for German banks. So where you have a point is that it comes in, and then the question is, how do they manage? So I think on this, I definitely will go back to you on it. Like we know that once it's then transferred, then the new value is there and it continues. But it's true, we're also quite surprised by the numbers that increase 7-fold over time.
Are you sure? I mean, the balance sheet is essentially an artifact for how the bank records these, but are they converting them into local currency, or are they keeping them in foreign currency?
So what we have is really the local currencies, like for all the things. That's why I say, like, I could look deeper into it. Right now, it's all local currency. And then the question is, do they actually convert it or not? And I actually don't have the answer currently. But as Natasha said, it's the first time we present a paper. So
it's a lot of them were converted. They were in foreign currency, but it's true that the values that we have are in domestic currency. So, yeah.
Okay, we have one final question from Marco Molteni. Why don't you use Z-score or standard deviation of ROA to a return on assets to proxy for risk? So it's about your measurement of risk and why you don't use some kind of measure
the Z-score.
Yeah, would be.
It's just another way.
Just a suggestion, I think. Yeah. Excellent. Okay, well, thank you very much. We've now hit the time for the end of the session. I think it was extraordinarily rich. I wanted to apologize to all presenters that you didn't get as long as I know that you would have wanted to have, and indeed that we would have wanted to have, to hear about the complexities of these papers. But I hope that they've given our audience a taste and a flavor of the really exciting and in-depth types of research that we can undertake to look at those processes of cross-border banking and their links to the real and financial stability in times past, both in times of crisis and in times of globalization. So thank you very much to all the panelists and to all the question askers. We don't have time for a break.
Catherine.
You're welcome. We don't have time for a break, which seems really terrible of us to schedule it this way, but I hope you're able to take a little breather on your own. And I'd like to introduce Rainer Klump now to take control, to take on the lion tamer role for the next session. Rainer?
Yeah, pleasure, Catherine. Thank you very much. Hello from my side. I'm Rainer Klump from Goethe University Frankfurt, also associated with the Institute for Banking and Financial History. And I have the pleasure to share this second panel session that will now go from the past to the present to give the full picture of what is the subject of this conference. As you can see from the program, we will have 3 presentations. I would ask each presenter to be not longer than 15 minutes. After each presentation, we would have like 5 minutes for direct questions that can be answered. And then we will have Loriana Pellisson, my dear colleague from Goethe University, who is discussing the whole of the 3 presentations. So then we will have a more general discussion, and we should be ready by 4:30 in time, because then we will have Claudia Buch, Vice President of Bundesbank, giving her keynote speech that will close the conference. So I would ask the first presenter then to start. It's Götz von Peter with co-author Tara Rice from the Bank of International Settlements. Götz, I hope you are here with us.
Yes, can you see me?
Just a few words of introduction. You're a principal economist and deputy head of international banking and financial statistics at BIS, and you hold a PhD from Columbia. And the title of your talk is on the global interbank networks and the retreat of correspondent banking. So, Götz, the floor is yours.
Thank you very much. I hope this works. Do you see it?
Yes, yes.
Excellent. Hello to all. Thanks for bringing us together. So I'll present mostly work that we did last year with two colleagues, Tara Rice and Kodruca Bor, both of the BIS. And if time allows, I'll introduce a data set I'm building now to try to extend this research further. So I welcome very much your suggestions. So basically, to understand the importance of correspondent banking, I think there's a very simple fact that one can appreciate, namely that most payment systems, even today, are domestic in scope and operate in a single currency. What links those systems across borders is primarily internal markets of multinational banks and networks of bank relationships known as correspondent banking. And so what most models, what most definitions of correspondent banking have in common is that the correspondent takes deposits owned by respondent banks in order to provide payments and other services to those banks, often across borders. And these arrangements are typically reciprocated so that banks can provide services to each other in their respective currencies and jurisdictions. And I'm sure that Catherine Schenk's Global Bank project will uncover fascinating facts on the expansion of these networks over time, over the last 150 years or so, and the resilience of these networks over time. Here today, I'll just speak about the recent declining trend we've seen over the past 10 years. And that raises the question, is this model of correspondent banking in a global retreat? And I'd like you to focus on this yellow line that you see here, which shows that the number of active correspondent bank relationships worldwide has fallen by 22% over the past decade. And that trend continued in 2019 and may well continue in 2020. And that has raised the attention of various international organizations concerned about access and costs, especially to developing countries. The CPMI actually collects a nice chart pack for anyone interested in more information and data on this. So the question is, why does this trend take place, and should be worried about it? And so three reasons or three takes would be, yes, one worry could be the loss of access of individual countries to the global banking system, the rise in costs for cross-border payments, and the risks to financial integrity if non-banks or other unregulated entities are taking over the business of cross-border payments. So the data set we're working here is received from SWIFT. And SWIFT is a global platform that allows for messaging between banks, between more than 200 countries and jurisdictions. So that allows to map the payments network either at the bank-to-bank level or at the country-to-country level. We're looking at the payments messages that are known as MT103, that's an on behalf of a customer payment, or the MT202s, that's interbank payments from one country to another. So a payment message sent from one country to another identifies a corridor between countries, and the count of active correspondence within each of these corridors is the AC measure that we're looking at in this paper. So as a simple illustration, country A has a corridor with the US, and there's 3 correspondent bank relationships because there's 2 banks sending messages, payment messages to 3 distinct banks in the US. That's what the SWIFT measure of correspondent banks measures. So why then is there a retreat of correspondent banking, apparently? So one reason is surveys have found that banks have reassessed after the global financial crisis their business strategies in a context, of course, of low profitability, dampened risk appetite, and tighter regulation and supervision. These surveys also indicate that banks have increasingly started to be worried about anti-money laundering and financing of terrorism regulations, and the compliance with those regulations has also led them to retreat from individual countries. And what we'd like to do here is to test for the generality of these factors. Now, the tricky part is that really requires a complete cross-section comprising as many countries as possible. Because if you look at, which countries have lost the most or the highest percentage of active correspondence, up to minus 100%, that's North Korea. And you see that most of these countries in the lower part of this distribution are countries that are either, offshore centers or fatter high-risk jurisdictions or countries sanctioned by the US. So in other words, an empirical regression needs to keep those countries that are somewhat marginal in the data set. And so the testing down approach doesn't really work, because if you put in all the regressors that you think might be important, you're ending up with a data set of 20, 30 countries, which are not the problem countries. And so what I've done here is to try to get to this with an approach known as global search, where I basically run a huge loop over thousands of regressions, with each taking a subset of the regressors. And then for each regressor, I keep record of the point estimate of this regressor and build a distribution of the point estimates. And for those regressors where the point estimates are generally away from 0, that is an indication that for almost all or for many combinations of regressors in a regression, that regressor will show up as important. And so basically that allows me to have very, very parsimonious regressions. And I'll present 1 or 2 of those regressions in this slide. So here, basically the regression is the percentage change in the number of active correspondents on country level variables in a large cross-section, right? So this one has 177 countries. And what we see here is, first of all, the constant here indicates that this is a fairly broad-based, retreat. So on average, 20, 30%, as I've shown in the beginning, of correspondent bank relationships have been lost worldwide. But looking at the various regressor point estimates also shows that there are several significant variables that suggest that the drivers identified in the surveys and policy reports indeed help explain which countries lost more relationships. So the first block, simply macro factors. So stronger growth consistently helps stem the decline. And of course, shrinking countries or crisis countries tend to lose more correspondent bank relationships. Trade growth also helps because, of course, facilitating trade has always been a key purpose of correspondent banking, as we've seen in the very first presentation by Wilfried as well. And size controls don't seem to matter that much in most specifications, such as population growth or GDP, but do help in very specific regressions. For instance, China, nobody wants to lose access to China or wants to stop providing correspondence services to China, for instance, simply already because of its size. A second group of variables tries to capture regulatory compliance issues, right? So for instance, jurisdictions that are widely designated as offshore centers here lost about 11 percentage points more active correspondence than other countries or indeed other financial centers. So that is indicative perhaps of these compliance costs in the face of anonymity and secrecy in those financial centers. So the designation of FATF risk status also accelerated the loss of active correspondence.
5 minutes to go, Götz.
Yes. And the single most robust risk-related driver is a corruption index. So countries perceived to be more corrupt have lost systematically more correspondent bank relationships. Now, why would we care in a way? Because part of this retreat is in a way natural. If banks reassess their post-crisis business models differently now, maybe that's a normal development. And parts of this retreat are also intended because there were efforts to enhance international financial integrity. And after all, the number of transactions and the value of cross-border payments globally continued to increase over those last 10 years. So in a way, why do we care? Well, one reason is the rise in costs, and I have some slides in the back of the presentation that I probably won't get to, that show that costs in generally cross-border payments generally tend to fall in cost over time, but for those countries that have lost more correspondence, they fall at a slower rate. So another concern is that loss of access. So basically, there's individual countries that have almost lost entirely access, such as North Korea, Somalia, and so forth. And now using the international banking statistics locational, basically shows that most jurisdictions still maintain open corridors from and to BIS reporting countries. A very simple network analysis basically shows this, that if you take 200 from countries, 202 countries, you get a matrix of about 40,000 entries. In at least 14-15% of cases, the sender country holds an interbank deposit with some bank in the receiver country. So that's kind of a direct relationship. In 74% of cases, the sender country can route payments through a third country, like the United States in the case of dollar payments, for instance. In another 6% of cases, this payment chain works through two intermediaries, right? So for instance, from Mongolia to the UK, to the US, to Bolivia. Now, 8 destinations cannot receive and 4 cannot send this way, and most of those are smaller Pacific islands. So this is literal loss of access is quite an exception. And here we can see that those countries that have lost both correspondence and corridors to other countries are actually the minority. So basically, in the minute or two that I have left, I'd like to just point out that I'd like to extend this kind of analysis in a more systematic way, using an overlay of various networks. Namely, I'm building this from-to network for both trade and overlay the international banking cross-border positions from country to country, and as well the present network. So that is, are countries headquartered in one country having a local presence in another country? And the white areas in each case indicates that I do not have the full network. But if you just look at the subnetwork for which I observe both banking and trade.
Yeah.
Yes. For those country pairs where I observe both trade and bank relationships, most countries connected through trade are also connected through banking, but only a minority is also connected through a physical bank presence. But that in the current context of the retreat of correspondent banking is quite interesting, because if you rank the countries by the size of their trade relationship from small to large, the larger that trade relationship between two countries, the more likely it is that they are also connected through a physical presence, which in the context of correspondent banking might just mean our internal markets perhaps substituting for correspondent bank relationships. It's entirely possible that the global transaction banks are internalizing some of that correspondent banking business within the internal markets of their banking group. Now, with this kind of network, one could also do other kind of experiments. For instance, is there a sequence when countries develop that they first develop their trade and cross-border relationships, and only then do they develop their bank presence with each other? All these are open questions, and I'd love to hear your feedback on which kind of areas are worth exploring with this. So I think in the interest of time, I'll conclude here. Thank you.
Thank you very much, Götz. That was very interesting to hear about this changes in the structure of how these international networks operate. I have one question here from Linda Goldberg. How have countries with lost relationships due to sanctions and FATF risks, presumably costly losses, respond to those losses? Is there any evidence that this led to reforms or mainly a reorientation of trade and finance as you plan to explore?
That's a great question. I don't have an immediate answer, but I do know that some cases such as Somalia, for instance, when they lose corridors with the countries they receive remittances from, they try to establish few safe corridors, for instance, with the UK, where those compliance issues have been overcome, so that other countries can route their remittances through banks in the UK, for instance. I don't have immediate evidence on how they reconfigure their trade relationships, and there's a World Bank report out that basically says they haven't found many extreme real consequences of the loss of correspondent banks until it literally comes to a cutoff from access overall.
Okay, thank you. I have three other questions in the Q&A. I would then stop. So first question from Tony Moore. Could the unexpected positive effect of US sanctions be explained by banks in those jurisdictions needing to establish new correspondent relations with non-US banks, and maybe several such relationships to avoid going through the dollar area? So is there a shift into other networks?
That's a very interesting question. I can't verify that with the data, with the SWIFT data, because that's really at the country level. It's an interesting thought, and it's entirely possible that there's some kind of diversification going on there. But the estimated coefficient, I should say, is positive, but it is not significant. So I don't actually know whether it's positive. And in some regression, it was actually negative and significant. So that's not a terribly stable coefficient to really put an interpretation on.
Okay, then we have a question from William Allen on Hawala banking. Hawala banking is an obvious and low-cost alternative to regulated banking in countries regarded as risk by FATF criteria. Is there any sign that Hawala has been increasing faster since correspondent banking started to decline?
I would believe that there has been recent quite strong growth in Hawala banking, but I must say I do not know enough about it to really make a stand here and give you a good answer there. But it is quite plausible. But for all alternatives of correspondent banking, it is good to keep in mind that many of these alternatives don't necessarily substitute for correspondent banking, but they're just netting and aggregating. And at the end of the day, those nets still often need to be transmitted in one way or another through a correspondent banking network.
Yeah, then a question from Raphael Heim. What, if anything, could be assumed from your analysis on the declining local banks' connections on stability of the international banking system? Is that?
That's a very broad question. I mean, one factor is that if you see volumes and value increase and the number of connections decrease, well, chances are that concentration is increasing, right? Now, I think I'm quite neutral in terms of concentration. I mean, obviously, extreme concentration on a single counterparty can be and is in regulatory terms also discouraged. But when risk assessment and fixed costs are in play and banks have to comply with, anti-money laundering legislation and so on, in some sense, it is a natural and perhaps a good development if fewer banks are doing it that are able to implement, the correct risk controls. So I wouldn't be jumping to conclusions here to whether that's actually a bad development. In some sense, from the risk side, it might be a good development.
Yeah, maybe we'll come back to that in the general discussion. Last question comes from Catherine, asking whether the number of banks has shrunk either through failures of M&A in money centers or in smaller developing countries. And do banks keep their SWIFT codes after they merge, or do they give up a SWIFT root number once they have merged?
Yeah, well, if they merge, they will probably, a SWIFT code is unique to a particular branch or subsidiary in a country. So to the extent that they merge within a country, they would probably share or use just one SWIFT code. Now, is this due to M&A? We've tried to test for that, but don't have enough data to really rule that out. But most of the consolidation has, with some important exceptions, of course, but most of the consolidation has really taken place before this entire decline, which is mostly taking pace 2012 and after. So I don't think it is really down to mechanical factors like consolidation.
Okay, thank you very much, Götz.
Thank you
for your presentation and the discussion. And we come to the next presentation by Beatrice Schäuble from the European Central Bank. Beatrice, who holds a PhD, I think, from Munich University, and she's now lead economist in the International Policy Analysis Division in the Director General International and European Relations of the ECB. The paper she's presenting is on swap lines in the global financial safety net, and it's co-authored by Hannah Engel-Jähringer and Alice Schwenninger. So Beatrice, the floor is yours.
Yes, thank you very much for the kind introduction. So I'm very happy to present at this conference because there is something to most recent development to which Linda has already alluded at the beginning, and that is the role of swap lines in addressing crises. And that's, of course, very closely linked to risks in the banking system as well. And given that swap lines are such a powerful tool, there's a surprising divergence in the understanding of how much they should be applied for different types of crises. And that's where our work comes in. So this is joint work with Hannah from the Santa Ana University, Pisa, and Alice from Banque de France. So my key messages today will be that we have seen an increase in the number of swap lines. We have seen an increase in the application of swap lines as a crisis fighting tool, but that is actually a result of financial globalization, and that it reflects increased cross-border capital flows, increased cross-border FX exposure, and that the swap line use really in the past has differed between different types of crises, and that this is also still the case. There are certain applications for swap lines for which they are a great tool and a powerful tool, and we've seen that in the past, but that doesn't mean that they are a one-size-fits-all tool that should replace all other elements of the GFSN. And with these key messages, let me move to something, maybe to give you a little primer on the GFSN as an international lender of last resort to those who are not so much into this concept. So the global financial safety net is considered the different elements of the GFSN are considered the international lender of last resort. This chart gives you a development of the resources in the different elements of the GFSN since 1995, starting with the turquoise line, which gives total stock of reserves. That's sort of a country's first line of defense. And the blue bars show IMF quota resources, which have been the most important second line of defense, or rather global line of defense until the global financial crisis. The yellow bars, they also depict IMF resources, but borrowed resources, which have become more important after the global financial crisis. And I could devote an entire talk to that. I won't, but if someone wants references or discuss, I'm happy to do so. And then something you can see in the orange bars, that's the regional financial arrangements, sort of regional funds to address regional crises. They also have become more important after the global financial crisis. And then in green, that's the size of all bilateral agreed limited swap lines. Doesn't include unlimited swap lines. So the biggest chunk is actually left out of this chart. But something you can see very clearly is the increasing relevance of bilateral swap lines here. And so a lot of the literature that has emerged recently has somewhat related this advent or this increasing relevance of swap lines to the fact that IMF may not be the best tool anymore. RFAs may not be the most powerful tool. We need to focus on swap lines. And this is not new. So this is actually a thinking that has emerged already during the past, or let's say after the past crisis, after the global financial crisis, when the literature focused again on, like, do we really need a global international lender of last resort? Is the IMF with its global membership not sufficient? So is there a theoretical foundation for an international lender of last resort? How should it look like? And then, like, this strand of literature after the global financial crisis, I will divide it into those who said the GFSN is patchy, the different layers don't work well, it's full of holes, some countries are not covered, it needs improvement. I would consider myself and Livio at the time in the more agnostic corner, saying, okay, the layers, they address different countries, different crises, they are complementary. Let's look into how they work together. And this discussion has sort of resurfaced since the pandemic. After the global financial crisis, the IMF's toolkit has already been revamped with a more swap-like tool. And now since the pandemic, there has been a call for more swap lines because some authors said the GFSN is not fit for purpose, IMF and RFA lending is not enough. The Fed needs to provide more swap lines. And I would also include the new SDR allocation, which is in the discussion into this, because special drawing rights are sort of a claim on foreign currency. So it's also about kind of providing more foreign currency funding to the economy, to the banking systems of the countries which use them. So this is kind of what has come up since the crisis. Then there are some central bankers who more or less discuss rather about theoretical purpose of swap lines for addressing CIP deviations, addressing mainly FX risk in normal times. But it is clear that there's this call, there's some technical discussion, what is the real purpose of the swap lines? And we want to shed light on this. And we thought, okay, we really need better data. That's where our data set comes in. And I'll start with a brief history of swap lines in the international monetary and financial system. And the key there are three key messages I would like you to take from the slide. So the first one is that swap lines did emerge in the 1960s. So together with, you may remember from the previous slide, the IMF, 1952, RFAs, 1977, 1978. So historically speaking, they emerged rather late. Previously, gold standard, not so much cross-border flows. There was just not so much need for addressing FX exposure. And then the interesting bit is that they emerged when there were cracks in the setup of the international monetary and financial system showing up. So this first US swap line is really nicely described in a paper by Michael Bordeaux et al. This emerged because under the then setup of the international monetary and financial system, the Bretton Woods system, there was an agreement that countries' central banks could exchange their US dollar reserves at a fixed rate for gold. The gold price rose. There were fears that the US would devalue the US dollar. So there were incentives, pressures that other central banks could exchange their US dollar reserves for gold. And the first US swap line was actually intended to remove this foreign currency risk, this US dollar risk from the balance sheet of the foreign central banks. And these cracks, which started showing that some of the setup of the Bretton Woods didn't work, of course, it broke down later. And so the third message I want to give with this slide is we've moved into a system where flexible exchange rates, capital flows, the exchange rate as an adjustment mechanism, but also differences in interest rates creating CIP deviations have become much more normal. So having seen that the first US swap line showed up to address this FX risk, now with moving to a more hybrid international monetary and financial system with these higher volumes of capital flows, with more FX exposure, we should really expect an increase in swap lines no matter what. And this is what I'm going to show you with our data. So it's not just a historical story which I'm telling, this is actually showing. This on the left-hand side, you see the same chart that I had shown before on GFSN resources, now all taken together in the blue bars, and in the yellow line, you can see total IIP liabilities as a measure of global capital flows. And the GFSN has kept in pace more or less with financial globalization. The interesting bit is on the right-hand side, because the swap line network has also grown more diverse. So up until prior to the global financial crisis, the global swap line network was more or less a US dollar network. And you can see that after the global financial crisis, there were more and more swap lines, the blue line you see on the right-hand side chart, in other currencies. So this swap line network is even more impressive if you look at it geographically. This you can see on this slide. Left-hand side shows you the swap line network in 1980. Very much US dollar centered, very much centered around the US Fed, versus the swap line network in 2020, which on this side, it even shows like being centered around the PBOC, because the PBOC just has a really high number of swap lines. But of course, it's a different story when we talk about US dollar swap lines. But this is much more a network than in the 1980s.
Mm-hmm. 5 minutes left, Beatrice.
Thank you. So how was this network used? You know, given that this is a conference on banking, so my co-authors and I wanted to look into how much are swap lines drawn during banking versus currency crisis. So are they really a tool for FX crisis or not? And you can see on the left-hand side chart, which shows you the agreed amounts during a crisis, that advanced economies didn't really agree additional swap lines during neither banking nor currency nor twin crisis. Emerging economies, however, agreed mainly IMF programs when they faced a banking crisis, not so much for a currency crisis, but no swap lines showing up. The orange part is the swap lines. Now, if you look at the drawn amounts, you can see that the advanced economies during banking crisis actually drew a lot from the swap lines. But given that this doesn't show up in the agreed amount, this is mainly from unlimited swap lines and only US dollar because we only have drawn amounts from the US Fed. This is not the case for the emerging economies. So do we conclude from this that it's mainly advanced economies which need US dollar liquidity? Well, something that we also looked at was the FX exposure. Is it that advanced economies are more exposed to the US dollar? And indeed, we see that when there's a higher gross external debt in terms of GDP, both among banks in blue and non-banks in banks in green and non-banks in blue, then we see a higher agreed US dollar swap amount. We don't see this for emerging and developing economies on the right-hand side. So there's a lot to learn, a lot we don't know. Something we looked into was, is this somehow related to currency invoicing? So we looked at the share of export goods invoiced in US dollar on the horizontal axis versus the agreed US dollar swap amount. And again, we see a positive correlation for G7, top left-hand corner, no correlation for EMDCs, bottom left-hand corner. We do see some correlation for EMDCs if the swap line is swap amount is not too high in terms of GDP for euro invoicing and euro swap lines on the bottom left-hand corner. So I've shown you some descriptive evidence, some stuff that you can do with our data. A lot of open questions we would like to understand more. Something that we have done to better understand the role of swap lines is that we've looked a bit into the question, what is their role in addressing sudden stops? And for this, we've used a parsimonious model that we've used to understand the spillovers from monetary policy and how monetary policy affects the likelihood of a sudden stop. So what we did here was to use a simple conditional log-log model. Left-hand side variable is just a dummy variable on a sudden stop here in portfolio bond flows. That's the usual Forbes and Warnock methodology. I won't go into detail of this. On the right-hand side, we just put a few control variables. One important variable you see in the first red box, which is the federal funds rate, later on shadow rate. Second box, bottom of the slide, different measures of swap lines. And you
1 minute, 1 minute.
Yes, thank you. And you can see in the coefficients on that slide that there's a consistent effect of the US monetary policy stance on the likelihood of a sudden stop after the crisis, whereas this is not the case for the swap line measures. There's some mitigating effect on if we use the total agreed US dollar amount as a percent of GDP, but the magnitude is lower than the magnitude of the federal funds rate and also much lower than regional contagion. This is not causal. A lot of GFSN variables still need to be included. We're fully aware of that. It's just to highlight that there might be different tools for different types of crisis. And that's also our conclusion. So the swap line network has kept pace with financial globalization. It reflects FX exposure. There is a different use of swap lines during currency versus banking crisis, and we need to understand more. But our early results indicate indeed something that we found also for other GFSN elements, that each GFSN element is working best in the crisis, in the type of crisis for which it was designed. Thank you.
Yeah, thank you very much. Beatrice, here comes one question from William Allen. You mentioned that after the global financial crisis that there was a more diverse network of swap lines, but as far as one can tell from the data, the large majority of the swap line drawings has been in dollars from the Fed. So is it the case that the non-dollar swap lines are unimportant in practice and the Fed has been the international lender of last resort?
Yes. So, on the data first. So swap line data are usually very confidential, and the Fed is the only central bank which makes public its drawings. And this is a database which we want to share widely, so we could only include the data which is available. This means that the drawn amounts are only Fed amounts, but it doesn't mean that the others weren't drawn. So that's the first one. The second one, is it really just the Fed? Now I have to be careful what I say, but let's say the international monetary and financial system is still very US dollar centered. And that means that any provision of US dollars is the most powerful tool. Mm-hmm. Interestingly, there are other central banks which also provide swap lines in US dollar. So some Asian ones, for example. But the amounts are obviously not as big as any amount that the Fed could grant.
Mm-hmm. That nicely fits to the question that comes here from Catherine, saying that not all swap lines are for the same purpose. For example, we have Fed swaps for local dollar auctions, but PBOC for trade finance in renminbi, so in China. The question is then, is it useful to group these different kinds of swaps together?
That's actually a very important point, which I always make when I talk about swap lines, because that's missing in the academic debate, that these swap lines actually have different purposes. And you might have seen on my history that even treasuries can give swap lines. So some of the Chiang Mai initiative swap lines are actually originating from treasuries. So yes, this is very important. For the purpose of this talk, we have actually grouped them together because it's, it's still a really nice network, but the database allows you to differentiate. So we have in the database not only the data set up in Excel and in Stata format, but we also have an explanatory Excel file, which actually has detailed text boxes on the purpose of each swap line.
Catherine, do you have a follow-up on that? Or you're fine?
No, I was just mouthing thank you. So.
Okay. So next question comes from Linda. Linda, you would like to ask directly? So
yeah, what's your perspective on the possible effects of the new Fema repo facilities?
So I have not included, well, we haven't included, and I haven't talked about neither Fema nor ECB repo facility. So we also implemented one. I think they're really a great addition. And so far, we haven't really considered them as part of the GFSN. But these gaps, which have always been lamented, that swap lines are only available to a very specific club, that sort of can be alleviated a bit and say by repo facilities. So, I mean, they haven't been there for a long time, but I think they will prove an important element of the GFSN.
Okay, then last question comes from Dagmar Alpen, asking whether your data set includes the time of the pandemic. And if so, did banks' behavior change in 2020?
So it does include the swap lines from 2020, but it's only very few. So the behavior, or the, let's say, whether a country gets a swap line, this is something you can analyze with the data. So you can just use a simple 0-1 dummy on the left-hand side and then put in certain determinants on the right-hand side. My impression is that swap lines have been used like they've used before, and they have been an important element, even though I should say the current crisis is different from the global financial crisis. So Linda has nicely elaborated on this. on the funding pressure among banks during the global financial crisis. And this was a crisis that originated in the banking sector, whereas the pandemic is a real sector crisis. So this is also why you've seen, for example, a much larger fiscal response early on than, for example, during the global financial crisis.
Yeah, Linda, would you have another question? I think we have all the questions taken. So thank you very much, Beatrice. And we come to our third presentation, and that bringing into the broader picture also the non-banking institutions. And this is a presentation by Inaki Aldasoro, who works with the BIS as an economist at the Monetary and Economic Department. He holds a PhD from Goethe University in Frankfurt. And the talk is about cross-border links between banks and non-bank financial institutions. Iñaki.
So first, thanks a lot, Rainer, Catherine, organizers more broadly for giving me the chance to present this recent article on cross-border links between banks and non-bank financial institutions and BFIs. This is joint work with my BS colleague, Wenqian Huang, and with ST Kemp from the FSB Secretariat, so the usual disclaimer for the two organizations applies. Now, NBFIs have played an important role in transmitting shocks during the Great Financial Crisis. And since then, their assets have only grown substantially at a faster pace than banks' assets. And this is well documented in FSB reports. Of particular concern are the links between banks and NBFIs, which are key quote-unquote conjunctions in the financial system. And as both type of institutions, banks and NBFIs can engage in credit, maturity, liquidity transformation, which could underpin accumulation of imbalances in normal times and also accumulate into pockets of stress during downturns. And these links between banks and NBFIs were behind particularly powerful transmission mechanisms, as demonstrated during the COVID market turmoil, which underscore several items. For one, that central counterparty margins can be procyclical and drain banks' liquidity at an inopportune time. That money market funds can be fickle funding sources, fickle funding source for banks, and that also banks' positions vis-a-vis NBFIs can also contribute to net long currency positions that then materialize in dollar funding shortages for banks. And all of these lessons had an important cross-border dimension. So what this article tries to do is a first attempt at a global mapping of these cross-border links between banks and NBFIs. We use the BIS international banking statistics and focus mainly on the residence of the counterparties. And this is going to be more like the first section was sort of purely historical. The second one was more modern, and this is going to be within the modern more conjunctural even. And less of a researchy type, more of a stylized fact-finding sort of exercise. So first, a brief note on the data. So the BIS locational banking stats capture links between banks that are located in a given jurisdiction and the NBFI sector in another jurisdiction. It is important always to bear in mind that these data are reported by banks, so they will reflect banks' perspective. So when we talk about claims, it's always going to be bank claims on NBFIs, and when we talk about liabilities, it's always going to be bank liabilities vis-a-vis NBFIs. And these two types of institutions are linked directly and indirectly, and the BIS data capture a subset of these linkages, namely direct claims and liabilities. And this graph illustrates how these linkages could enter banks' balance sheets. So for instance, if a bank would invest in CLO or extend loans to finance companies, this would show up on bank assets as claims on NBFIs. And in turn, bank liabilities could reflect funding from, say, MMFs by say, repos or commercial paper, or more broadly, deposits from NBFIs, among others. Credit lines are, which were, as pointed out in some of the presentations before, an important aspect and important development in Q1 last year, are off-balance sheet commitments that are going to appear to the extent that they are drawn. They will appear as both loans and the corresponding deposits. Something that is very important to keep in mind here throughout the presentation and when looking at the data, if you go and browse it on the BIS website, is that we only see positions vis-a-vis a BFI as a sort of collective and the NBFI collective. So we do not know whether the counterparty is, say, an investment fund or a hedge fund or a CCP and so on. And I will come back to this later. So bank cross-border claims and liabilities with the NBFIs grew strongly in recent years. So here we start in 2015, which is when a significant amount of reporters start reporting this breakdown in the BI statistics. It grew from about 4.6 trillion in the first quarter of 2015 to 7.5 trillion in the first quarter of 2020. So there is a notable increase in volume, but there is also a notable increase in terms of a share of total cross-border claims and liabilities, as you can see in the left-hand panel. And as you can see in the center panel, the US dollar dominates these cross-border positions with NBFIs, with more than 50% of both claims and liabilities being denominated in US dollars. And finally, the cross-border links between banks and NBFIs exhibit a high degree of geographical concentration. Now, granted, the concentration is a feature of cross-border banking more broadly, as we have documented in other work in the BIS quarterly review. But it is particularly high and rising with respect to non-bank financial institutions, as we illustrate in the right-hand panel of the graph by means of standard HHI indicators. And this concentration can be clearly seen in this network graph, which probably guaranteed my participation in a interbank network conference. And the left-hand panel here plots the network of bank cross-border claims on NBFIs as of the first quarter of last year. The size of the nodes is proportional to the value of the links. The color of the links shows the location of the bank that holds a claim, and the width of the links is proportional to the value of the claim. So, for instance, if you look at the UK and the US, if we want to capture claims of banks that are located in the US on NBFIs located in the United Kingdom, these are captured by the green link between the green and purple nodes here. And if you want in turn to capture the opposite link, so this is the purple link going in the other direction, this will capture the claims of banks located in the United Kingdom on NBFIs located in the United States. And of course, the same logic applies to the network of liabilities. Now, the patterns across claims and liabilities and across counterparty countries, so crossing these two dimensions, can shed light on the type of NBFIs with which banks have cross-border positions. And this brings me back to the point of the fact that we don't really know exactly which type of NBFI is behind these positions. So, for instance, banks in Japan have sizable claims on NBFIs in offshore financial centers, and this is going to be mostly Cayman Island. This is the orange bubble on the left. And this probably reflects banks' holdings of securities such as CLOs, which are issued by securitization vehicles that are located in these jurisdictions. This is well documented in a lot of say newspaper articles and so on, and also in the reporting of some of the banks. The claims of banks in the US on NBFIs in offshore financial centers also probably reflect similar activities, as well as prime brokerage business with hedge funds. It is also likely that central clearing contributes to the strong links that we observe between the UK and the US, as both host internationally active CCPs. Banks in the euro area and in other advanced economies like Canada and Australia, which are captured all in the blue node, have substantial claims on NBFIs in European financial centers. And here we take together Ireland, Luxembourg, the Netherlands, and Switzerland. And European banks also have large claims on NBFIs in the US as well, reflecting exposures to US finance companies and US SPVs, as has been documented in detail in a paper by Richard Portes and co-authors from a couple of years back. Now, you see here that EMEs are very small, right? So this is because the positions between advanced economies and offshore centers just dominate by the sheer size. But it is worth pointing out that the cross-border links between banks and NBFIs have also grown quite a bit in EMEs in recent years. And they can represent a substantial share of overall cross-border claims and liabilities for these countries, as you can see in the left-hand panel here. So in other words, while in the network before they looked sort of marginal, from the perspective of EMEs, the role of NBFIs is certainly non-negligible. And it has been growing strongly. And similarly, as it was the case for the total positions that we saw in the first graph a couple of slides back, the US dollar also looms large for some EMEs, as you can see in the right-hand panel.
Yeah, 5 minutes, Iñaki.
Thank you. Now we go to the most conjunctural part of all. So the vulnerabilities during the COVID market turbulence in March last year, which they surfaced very strongly in terms of the bank NBFI links. So on one hand, banks claim on certain NBFIs, such as hedge funds, increased financial leverage. And during the severe financial stress that was caused by the pandemic fallout, the unwinding of these leverage positions exacerbated fire sale and drained market liquidity, as was well documented by colleagues in a series of BIS bulletins. And in addition, banks' links with CCPs can transform banks' counterparty credit risk into liquidity risk. And on the other hand, banks increasingly rely on NBFIs such as MMFs for short-term funding, which can suddenly dry up and cause market disruptions. More broadly, the cross-border links between banks and NBFIs will tend to underpin FX positions that can generate liquidity and maturity mismatches, as I mentioned earlier. So the bank cross-border claims on NBFIs saw like a really substantial spike in the first quarter of 2020 of roughly 800 billion, US dollars, which could be partly the result of drawdown of credit lines from banks. We see in the left-hand panel, in the first panel on the left, that NBFIs located in the United States, the United Kingdom, and the Cayman Islands accounted for much of this expansion. These are the first three set of stacked bars, and most of which was US dollar denominated, as you can see with the red bars in the graph. Increases in bank cross-border claims on NBFIs in the UK and Japan also probably reflected in part gains on centrally cleared derivative positions with CCPs that are located there. So we see in the second panel that historically changes in cross-border bank claims on NBFIs in the UK and Japan have tended to correlate positively with changes in CCP initial margins in the same countries. And you see how much of an outlier the first quarter of 2020 was, with very large margin calls as CCPs sort of stepped up their protection from counterparty risk, which generated a sudden and massive increase in margins that in turn generated the liquidity strains for clearing member banks. Now, as the third panel shows, also cross-border bank liabilities, two NBFIs were heavily affected by the March turmoil. The increase was of about 780 billion in the first quarter of last year, which was exceptional by any standard. And just as with changes in claims, NBFI drawdown of credit lines can play a role here, because as the credit lines are drawn, they generate the corresponding increase in deposits at banks. Furthermore, to the extent that the CCPs are actually intermediating between banks that are on opposite sides of derivative contracts, gains on contracts for some banks, which are claims on NBFIs, would go hand in hand with losses for other banks, which are liabilities to NBFIs. And this could partly explain the increase in bank liabilities vis-a-vis NBFIs located in the US and the UK. It is important to also note that the expansion of bank liabilities to NBFIs in the first quarter masked underlying vulnerability that can stem from some funding sources. I mentioned here, I have in mind particular US MMFs, but also banks rely on offshore financial centers for the US dollar funding from NBFIs, as we saw also in the network graph before. And the importance of these centers in bank cross-border liabilities to NBFIs is linked with that of the US dollar, as we show in the fourth panel. The NBFIs in these offshore financial centers, think of hedge funds, MMFs, other investment funds, they tend to have a short investment horizon, and they can amplify dollar funding stress for banks. So we also look into the role of NBFIs, trying to dig deeper into this issue of dollar funding shortages. We shift gears and switch to statistics aggregated by bank nationality. So we no longer focus on German banks, banks in Germany, and we instead focus on German banks throughout the world.
One minute.
Thank you. The data reveals apparent net long positions in dollars vis-a-vis NBFIs, as you can see in the left-hand panel, in the mismatch between red bars, negative and positive. And this will tend to contribute to apparent net long positions vis-a-vis all counterparties, as you can see in the right-hand panel. Now, banks will typically hedge these positions via FX swaps. So they will eliminate or reduce currency mismatches, but the short maturity of these instruments typically generates liquidity mismatches, which leaves banks vulnerable to US dollar funding shortages, and such shortages took center stage during the COVID crisis, as is well documented. So in the interest of time, I will not repeat the main conclusions of what I said, but just let me point out that that our article, while it adds to understanding of NBFI bank nexus, it also points to important data gaps, which is very important to fill if we are to gain a fuller picture of financial vulnerabilities and the related transmission channels. And these dimensions include domestic exposures between banks and NBFIs. Here we concentrated only on cross-border. Also, the specific type of NBFIs that banks have as counterparties. Is it a CCP? Is it an investment fund? Is it a hedge fund? And so on. The exposures within the NBFI sector, which is a full blank for the data that I'm aware of, and also the financial instrument underpinning all of exposures. And given that I'm under the watchful eye of the deputy head of the banking statistics, I also want to strongly encourage you to browse the interactive graph that we have put together with this piece in the quarterly review, which I hyperlink in the slides, and you can also find in the web. It allows you to see the network graph over time by currency, split by claims, liabilities, and net positions, and all downloadable, by the way.
Okay.
So let me stop sharing, and I think I was right on time.
Other questions from the audience? Yeah, here comes a question from Catherine. Is it possible that some NFBIs are subsidiaries or otherwise related to banks? So there is an internal capital market function observed.
I think in principle it is possible. I think in the data that we have used, this is stripped out because you can separate out intra-group positions with the location of banking statistics, and this is sort of net of those.
Mm-hmm. Okay. Other questions? If that's not the case, maybe we come back to this after the next presentation. Or it's not a presentation. Thank you, Iñaki, so far. Now we come to the, what is called the discussion, which is led by my chair, my dear colleague, Loriana Pellizzon, Professor of Finance at Goethe University, and also research director at the Leibniz Institute, SAFE. Loriana, you hold a PhD from London Business School. And well, you have the floor to discuss the three presentations that we've just heard.
So thank you very much for inviting me to read and look to these three very interesting papers. Clearly, I don't have too much time, and I'm not going deeply on each of them. So I will just say a few things regarding all the three, and then I will try to, let's say, pose several questions that will affect or will be related to all the three, let's say, papers, and what we are learning from these three papers that are largely describing how is this interconnection among, the flows or financial institutions across the world. But clearly, the evidence that these three papers are providing is pretty much raising, I think, a lot of questions. And I'm just, putting these questions. That's the way in which I prepare my discussion. So the first paper is, from my point of view, investigating this research question. What is driving the retreat of correspondent banks, and what are the potential consequences? And if I want to, to sum up the key points that it has been raised, so the paper is documenting a significant reduction in correspondent banks, and it is in a sense trying to disentangle what are the main reasons for this. And one is business model. It seems, that holding this type of correspondent banking is too costly. It seems that there is some role in terms of regulation, and clearly under regulation we have all the aspect related also to let's say corruption and the attempt to reduce to penalize some countries and so on. In my view, there is one aspect that it has not been stressed too much in that paper, and is if the payment system for remittances is now in the hand of non-bank financial institutions, thanks, for example, to the technological development. I'm giving below three examples, but this aspect, the technological development, it has been captured a little bit in the paper by telephone transfer and also by, as an explanatory variable, the level of internet connection, that seems also to be a relevant variable to explain the reduction in the correspondent banking. So I think that it would be nice to try to investigate more if actually, mostly maybe when there are barriers imposed by government on transferring money from one country to the other, there are other ways, to still transfer money, like, for example, via Bitcoin or in general coin-based, let's say, transactions that clearly are not included in the, I think, in the statistics that we are looking so far, or, for example, TransferWise. Just to give an idea, I think that all of you knows how it's working, but pretty much TransferWise or Wise, this new company, it has been set up that, to my knowledge, is largely used. A lot of friends of mine are using it. So I don't have statistics, but I think it is relevant. Pretty much, use the account within the countries to transfer money across countries. So this is the idea behind this, this platform. And by the simple fact that, this platform exists, you have that correspondent banking transactions are going to reduce. So it will be nice to have a focus and try really to disentangle how much of this reduction is due to the technological change. That's regarding the first paper. Regarding the second paper, well, it's a very complicated paper, and is also trying to answer an extremely important question. So what is the role of swap lines, and are they really global financial safety nets? It is very nice because, it's giving to us a very nice picture on the evolution also of the swap lines, of the fact that they are not just related to the US dollar, but, they are growing also regarding other type of currencies. So it is something that has been heavily used now by all the different central banks. So it seems that it's really having an important role. And in fact, what they show is that they respond largely to forex flows or exposure. And clearly, they are trying to dig a little bit more, but and they say that maybe it's due to the data they have, but it seems that this is related to the key role played not only by the Fed, but by the dollar in general. And this is why it's making the swap lines for the dollar so relevant. And then they are trying also to try to understand when are these swap lines relevant, when are they used the most, and clearly it's coming via crisis, but it depends also on which type of crisis. So, currency crisis and bank crisis maybe they have a different demand in terms of these swap lines. But for this paper, I have a more general question. And that it is the following: what and where are the frictions that prevent the market to work without the global financial safety net regarding, dollar? Because here it's said that we are talking about this, the possibility to get, dollar in the repo market via, involving still the Fed, but via providing as collateral treasury bills. Why the market is not able to do it by itself? What is the friction? These type of analyses are very nice because they are describing really what is going on. But as a researcher, I would like that if it is possible to do a step further. Where are the frictions? Why the market alone is not able to provide this type of safety net and is not, able to provide this type? So is it an issue regarding the amount of cash? Dollar is too much demanded, and there is not demand. There is scarcity of the dollar. there are some conditions in which the dollar is scarce, you know, it will be very nice to then to measure how much is the scarcity and how much these swap lines, you know, are just the signal of scarcity or maybe the signal of some other friction in the market. Well, regarding the last paper, again, it is a fantastic analysis on the cross-border links between banks and non-bank financial institutions and how this has been evolved through time. And what is coming out is that this type of linkages cross-border are increasing. And you know, they have grown 63% in the last 5 years to 7.5 trillions, just to give an idea of how large it is. And they're trying, you know, also to figure out what are the vulnerabilities of their linkages that has been significantly increased with the COVID-19 shock. They identify two main, let's say, vulnerabilities. One is the procyclicality of the CCP margin. And again, the other is going back even to the previous paper, the dollar funding from non-bank financial institutions. But I think that it will be nice to explain why we have this trend, you know, because this problem about the dollar, the demand for dollar, it was present even before. So now, why now this is done by non-bank financial institutions? So again, what is the main driver? It is just regulation that is imposing the CCP and therefore the margin, or there is something behind this. So what are the economic functions of the different non-bank financial institutions that are going really to increase this type of cross-border linkages? So if it is maturity mismatch of other similar function of banks, such as cash management vehicles that the non-bank financial institutions are in a sense implementing, observing this increase in the growth, this clearly is asking for a regulation, because pretty much banks are putting out of their balance sheet, again, a lot of their activities in terms of maturity mismatch and cash management, that we know that when they're doing this, they're out of the radar, and it is largely for regulatory arbitrage. So it would be very nice to figure out if the result of this trend is because the system is becoming more efficient, or you know, it is just because we have a trend in regulatory arbitrage that is going to increase, or something else. Mm-hmm. I'm going now trying to have an overview of all these different
5 minutes.
Yes, I'm almost done. About all these different papers. And so the picture, the overall picture that we have is that international financial linkages are increasing. The only corresponding banking linkages is reducing. And we still don't understand why this is the case. But the trend in general is that these linkages are increasing. So clearly, I think that we need, after these three different evidence, we need to ask and try to answer to the question of what are the main drivers of this increase of the cross-border linkages, and where are going all this money, you know, because linkages means that there is a lot of money going from one place to the other and maybe go back again. So the question is, why are we having all this money going around? Are they driven by trades? Are they driven by investment? Are they driven by lending? You know, what is behind? And what are, and why in some sense we have that a fraction of this type of movement are moving now away from the banking radar, but still we have the bank involved because as the graph, it has been shown, among bank assets and bank liabilities, now we have always a non-financial, a non-banking financial institution, a non-bank financial institution. So are we simply increasing the number of the intermediaries? So what before it was done by banks in an internalized way, it is now going out from the balance sheet of the banks and then go back again to the balance sheet of the banks. So clearly we're just increasing the channel, let's say the chain, and maybe reduce the efficiency because we are putting markets then in the middle that are subject maybe to fire sale and so on. When all these type of activities before were done internally in the balance sheet of the banks. And, you know, it would be nice to understand better this type of pattern. And if at the end, since there is a concentration also, this is what is coming out from the last paper, in terms of non-bank financial institutions, you know, is there then a concentration on risk on borrowers? So at the end, you know, we have some bottleneck on where money are going from one place to the other. And the main question, I think, is who is at the end, with all this flow, the financial sector serving with the cross-border linkages? Really looking to all this graph, you get the feeling that, you know, there is an intensification of the money going from one place to the other. There are also a lot going to this Cayman Island that it would be nice to understand why there is all this need to go on these type of places. But, you know, we cannot just document this type of flows. We need to try to understand why we have this type of flows.
Okay, thank you very much, Loriana. You did a very, very good job. And I think we can now start with giving the three presenters the opportunity to react to the questions you raised to the three papers, and then we can go ahead with a more general discussion. So Goethe, would you like to start?
Thanks for this effort in putting under one umbrella all these three diverse papers. So you're raising a lot of interesting questions, which I think within the few minutes we have, we can't quite answer. But on your specific questions on my presentation, so you're quite right to say we haven't gone far enough with exploring how new technologies and new NBFIs that use new technologies like TransferWise, Revolut, and so forth are shaping the landscape of correspondent banking. That is true. Now, I would only just say it's not a foregone conclusion that, you know, having more technology-based payment solution doesn't necessarily obviate the need for correspondent banking, because even though some of these firms can be viewed as netters, they will certainly contribute to reducing the amount that is transferred through this mechanism, but they're not necessarily precluding that, you know, you still need the infrastructure, because if, for instance, TransferWise, as you rightly point out, is using local bank deposits in each country in order to offset and make payments across countries, but any imbalance, you know, between what it pays to and from any country pair would still, in a way, have to be settled in some way. And for that, it would still use the banking system, and for that, it would still use correspondent banking. But that's certainly a space worth watching further, and there's a very large CPMI effort. Tara Rice-McArthur is actually intimately involved with this, try to make a very big international push to try to make cross-border payments cheaper and to bring in infrastructures, to link infrastructures. And so that's a very interesting space to keep watching. So I think with this, I'll leave it to other commentators.
Can I just add one thing on your point? I perfectly agree with what you said, but you know, there is also a secondary effect that when you are transacting only the net, then the business model that you already pointed out, it maybe is not any more profitable. It is not the same as having transaction for the gross or having transaction only for the net. So that's why I think the business model also is going to be bring into the picture.
Yeah, you're quite right with that. And certainly also you might in the process be consolidating the net payments with a financial center where you can reconcile
Götz, I'm very sorry, I have to stop you in the sake of time. We also have to want to give the others the opportunity to react. Yeah, thank you very much for your understanding. Beatrice, please.
This will be very difficult because Loriana has asked this super broad question for me. What are the frictions that prevent the world to work without the GFSN? I tried to give you a few thoughts and keep them very brief, but just to say that your comment on understanding the frictions is really spot on. There's so much we don't know. So I just give you a couple of ideas on origin, what are the frictions in between and why we want to address them. So on the origin, I wrote down 2 points. One is globalization, one is exorbitant privilege. So an international monetary and financial system centered around the US dollar and its setup creates incentives for the buildup of imbalances. And understanding these imbalances is the first step to understanding kind of where and how we need the GFSN and what are the flaws of the IMFS. Globalization intensifies this whole thing. Globalization tells us kind of or intensifies flows and therefore also intensifies the possibility for the buildup of imbalances and spillovers. Then, of course, we need to better understand, even with these systemic or with the setup of the system, there are frictions in the system. And I've just written down trade invoicing, which is something historical, which drives these flows, and also is one reason why deviations from or opportunities of arbitrage may be used and may be emerged. Also, a lack of domestic financial markets when I think about emerging economies. But taxation is also one of the frictions which drives international flows, which is very relevant. But in some, is also a big data question. We don't, like the international capital flow data that we have is so deficient that having better data, bilateral flows data where data is going would be good. Why do we need the GFSN? Just 3 words or 3 points. One is, of course, we need to consider other effects than just efficiency. We might have financial stability considerations. We might have distributional effects. We might have inefficiencies in the banking system. So yeah, there were so many things coming to my mind, but I think your question is really well taken and spot on.
Yeah, thank you very much, Beatrice, and I hand over to Iñaki.
So first, thanks a lot, Loriana. I second Götz in saying that very good job in sort of putting everything together in a single wide-ranging comment. I think you raised a lot of questions which are very deep, and like, why do we have this trend? I think what I can say is that the way I would think about these issues is I would first start by sort of like separating the things in compartments. So these NBFIs are very different animals, and we need to understand and get better data on each of them, because each of them will have very different implications. If you think about, for instance, insurance companies and pension funds, which will be lumped together in the data that we have here, that I have presented, this will behave typically more like countercyclically, will not have the same financial stability implications as the behavior of hedge funds and how they unwind positions under stress. To what extent? I mean, and this also implies to what extent regulation plays a role, and for that one also needs to distinguish the different type of NBFIs. You mentioned CCPs. I mean, yeah, there are the margins there, and this was very clearly regulation driven. There was a strong push towards central clearing of derivatives, especially post-crisis, but there were good reasons for this. So if there are issues with the procyclicality of margins, they need to be better understood, analyzed, and then contained. Something similar applies to MMFs, where are a creature that have existed for a very long time. Some people would say that they their birth was sort of regulatory driven because of regulation Q in the US. And that's how what got them started as an alternative to bank deposits, the rates of which were capped. But I mean, they have been there for a long time, and sort of they have established themselves as a very important source of dollar funding for US banks. And it's, to me, it's that linkage with the banks that is of critical importance in understanding. And when it comes to analyzing these sort of sub-markets, there are data that are more granular that can help in addressing those. And I think that's the work that I see more promise in developing. And also, I mean, with as more data comes for the data that we have, which is at the country level, so we get exposures of banks the collective of banks in a certain jurisdictions vis-a-vis the collective of NBFIs in another jurisdiction. We have this bilaterally, and then in the future also more analysis can be done on this. So yeah, I think this is all I have to say. Thanks again. Yeah. And it's good to see you, Loriana, again.
Thank you very much, Iñaki. And also thanks again, Loriana, for this very, very precise screening of the three different papers. I think the more general issues that you raised, such as who is served by all these different networks and whether there is complementarity or substitutability between the different networks. These are questions that are really open for further research. And with that, I hand over to Catherine for final remarks. Catherine.
Thank you very much, Rainer. And thank you, Claudia, for a great capstone to our day. It's been a very full afternoon, and I congratulate everybody who's made it through. I think it has been a very rich conference, and I really wanted to thank all the participants and panelists. I wanted to make a few remarks, just drawing things together. I posed the question, are international bank networks sources of stability or instability? Are they sources of resilience? Are they sources of spreading risk? And of course, we haven't quite answered that really big question. But I think we have a few insights that I'd just like to draw out. The first is that all the papers are busy trying to observe, trying to reconstruct, trying to document those international bank networks. And I think this is still an ongoing process. So even to ask the question requires this fundamental research still, which I think is an important observation. We heard in terms of the papers, I think the two sessions work very well together. The first theme perhaps is the importance of non-bank financial institutions. And we heard about those from Olivier Ekmanotti, from Mark Carlson in part about the securities markets and securities lending, and also of course from Iñaki with the contemporary data on those trends. So that relationship between international bank networks and non-bank financial intermediaries, I think, is crucial. The second theme I brought out was how crisis or how risk can be transferred through networks. So the route for the impact of cross-border flows is another theme that was brought up by Mark Carlson and also by Natasha Postelvine in their papers, but also in part, I think Iñaki's sort of hinting at it when he's looking at the links between bank and non-bank financial intermediaries. And the final theme I wanted to bring out is about the architecture of international banking and these international bank networks and how they change over time. And this was addressed in papers by Goethe, by Wilfried, and indeed by Beatrice and her swaps. And this is something that I'm really interested in. And I just wanted to pitch you my current project, which has just started last month, funded by the European Research Council. And it's a 5-year study looking at that underpinning architecture of the international banking system, which is the international payment system across the 20th century, by reconstructing laboriously every bilateral banking relationship in the world from 1870 to 2000, so that we can see the dynamic changes that happen in response to crisis, in responses to changes and shifts in economic growth and economic development, and also the changes in strategic conflict, but also in technology as those affect international and global payments over time. So I wanted to just give you a kind of a little advertisement, I guess, of that future research, which I'm so excited to bring to Frankfurt next year as the visiting professor. I want to thank the Bankhaus Metzler and the Friedrich Foundation for supporting this, this visiting professorship and its patience in waiting for my ability to physically come there. I think it would not have worked to do it completely virtually. I really want to meet the students. I want to sit down and have coffee with Rainer and his colleagues at Goethe University. I want to go to the ECB. I want to go to the Bundesbank. I want to meet physically and build relationships with people in Frankfurt. I'd also like to thank, of course, the House of Finance and the the Institute for Banking and Financial History, with whom I've had an ongoing relationship, and the Leibniz Institute for Financial Research, SAFE, which sponsors or helps with that visiting professorship, but also with today's conference. I wanted to thank Rainer Klump for stepping in to chair the second session. And as I said, I really look forward to being his colleague, not just virtually, but in reality next year. And finally, I'd like to send out a special thanks to Hanna Flotte-Degenet and Daniela Dimitrova, who supported this conference and kept us all in train, all informed about what was going to be happening, and publicized the conference so effectively that we got a really fantastic audience. So thank you to the audience also. And with that, I'll say, go and have a relax. I wish we were all going out for a drink just now, but next year perhaps. So thank you very much, everybody.